Assalamu alaikum everyone. I, Nazia Akmal, on behalf of the Northern Regional Committee of ICAP, welcome to all of you on this, the fourth and last day of IFRS workshop. We believe that this workshop offers great value to update your knowledge about the topic. We have with us Mr. Yasir Riaz for today's session. Mr. Yasir is a fellow member of the Institute of Chartered Accountants of Pakistan with over 18 years of expertise in IFRS. He has trained professionals in both national and international entities and provided valuable assistance to finance organizations in various areas, including financial instruments, hedge accounting, deferred taxation, and business consolidation. Mr. Yasir has conducted numerous ICAP workshops and delivered corporate trainings for WorldCall Telecom and NetSol. He currently serves as a partner at IY Chartered Accountants, offering a range of services including assurance, advisory, tax, risk management, corporate finance, ECL modeling, IFRS implementation, and bookkeeping. Please join me in welcoming Mr. Yasir Riaz. To make the most of today's session, please feel free to type your questions in the chat and Mr. Yasir will address the questions. Thank you. Sir, please.
Now share. ओपन करना है जी ये बड़ा इशू जी और इसमें अगर वो मैंने स्विच करना हो एक्सेल फाइल में Okay, Assalamu alaikum. Today's presentation is basically on these 4 international financial reporting standards. First of all, we will be dealing with IFRS 16, and then IS 19, and then IS 23, and in the last, we will be discussing IS 33. First of all, IFRS 16. Previously, there were 4 documents by International Accounting Standard Board, and those have been replaced by International Financial Reporting Standards 16. IS 17, which was primarily dealing with the accounting of the leases, and SIC 15 was dealing with incentives in operating lease, and then IFRIC 4 was dealing with more complicated areas, whether the contract is a lease or not. That was covered in IFRIC 4. And then SAC 27 was dealing with evaluating the substance of transaction involving the legal form of the lease. So these were the 4 documents which were dealing with the concept of leases. And now all these concepts and with certain additional information is provided in IFRS 16. What are the main differences which has been changed from the previous IS 17 and now what IFRS 16 is requiring? First of all, IS 17 was requiring classification of lease both by the lessee and by the lessor. But now the IFRS 16 is only requiring a classification of lease from the lessor point of view and not from the lessee point of view. In IS 17, there was no specific guideline for separating lease and non-lease component. As we know, there are many lease contracts which contains some non-lease components like servicing elements in the lease contract. So previously there was no guidance how to deal with the servicing component and whether to separate the lease from the non-lease component or not. Now IFRS 16 is providing a complete information how to deal with lease and a non-lease component. And then lease term and lease payments required to be calculated at the inception of the lease. There was no information given in IS 17 that if there is a modification in the lease contract or there was no reassessment opportunities available in the IS 17, but this standard is providing complete information for reassessment of certain areas of the lease contract. And if there is a modification in the lease contract, so whether that will be a new lease, that will be part of the existing lease, and how to deal with the modification is provided in IFRS 16. And then previously IS 17 was not providing complete information on contingent rent. What is contingent rent? And almost everything in the lease contract, which is not initially part of the you can say lease accounting, was accounted for as a contingent rent, but now IFRS 16 is providing information how to deal and what is basically contingent rent. And then similarly, there was no information in IS 17 for subleases. This IFRS is providing accounting for subleases as well, and giving the concept of head lessor and intermediate lessor. And then no rules for modification for the lessors in IS 17. This standard do provide or does provide how the lessor will account for the modification. And then previously a very surprising accounting was given in IS 17 for sale and leaseback accounting, which was giving rise to certain, you can say, deferred gains and deferred losses and de-recognition of assets. Even the major risk and rewards of the asset rest with the lessee. This standard is providing a very comprehensive information that whether a lease, whether the sale and leaseback is covered in IFRS 16 or that will be accounted for under IFRS 9 as a financing transaction. And then some leases remained off balance sheet. There was a concept of operating leases in the books of the lessee, but now almost all of the leases will be on the face of the balance sheet as far as the lessee is concerned. Still, the lessor is having certain off balance sheet items. And then whether the lease contract with different parties or with a single party, you have more than one contract, whether those can be combined together or not. There was no information in IS 17, but this IFRS does provide the information and rules for combining of lease contracts. Then we have objective of the IFRS 17 to specify the principles for recognition, measurement, presentation, and disclosure of leases. This is, you can say, the objective of this IFRS. It will be providing whether it will be providing the information whether the contract is a lease or not, and then if it's a lease, then what should be the accounting treatment in the books of the lessors and the lessees. And then there is the scope paragraph that IFRS 16 will not be applying to these types of contracts, like leases to explore natural reserves like minerals, oil, natural gas, and similar regenerative resources. That will be covered in IFRS 6. IFRS 6. Leases of biological assets is covered in IS 41. And then intellectual property licenses is covered in IFRS 15. Sometimes you give the right to the customer to use your intellectual property licenses. So that will be a revenue under IFRS 15. And then service concession arrangements. Sometimes there are certain BOT arrangements. Those BOT arrangements will be accounted for under IFRIC 12. And then if there are certain licensing agreements, those will be covered under IS 38, and that will not be in the ambit of IFRS 16. Particularly those assets which are normally come under the ambit of IS 16 and IS 40 will be covered under IFRS 16 if that contract is a lease. What is a lease? It's a very important definition. A contract or part of a contract, as we already said, that the contract may be involving or including some lease and non-lease component. So if you can say separating lease and non-lease component, then that part of the contract, which is basically a lease, will be accounted for under this IFRS. Contract or part of a contract that conveys the right to use an asset. And the very important word is identified asset or part of an asset or identified part of an asset in exchange for consideration. If there is no consideration, there will be no lease. So it's very important. There are certain very important aspects of the definition. First of all, it's a conveyance of right. It gives the right to other party for use of, you can say, the lessor's asset or the owner's asset. And then that asset must be identified. Later on in this presentation, we will be dealing what is identified and what is not identified. And then for a period, there is a specific period for which that right is being granted to the lessee, which is normally called as lease term. And then exchange for consideration means there is a consideration to be paid to the lessor for this conveyance of the right. So there are very important concepts. One is lease payment and the other is lease term. So if we present it graphically, the lessor conveys the right of an identifiable asset to the lessee against the consideration for a period is called as lease. इसको हम lease के तौर पे identify करते हैं. It's a very important concept. Previously, this concept was covered in IFRIC 4, but now it's part of the standard. Okay, what type of contract is a lease? Whether this contract is a lease or not. So throughout the period of the use, the customer has both the following rights to the identified asset. In the previous presentation part, we basically identified it's a conveyance of the right. So it's a conveyance of right to the customer for what type of asset? Identified asset. And what that right conveys, or what that under that right, what the lessee has the right to obtain substantially all of the economic benefit. If that wholly solely asset is given, then all of the economic benefits of that asset within that period, which is lease term, basically of the lessee. And then right to direct the use of the right to direct the use to get economic benefit. Sometimes the asset is basically with the contract, under the contract, the lease is delivered to the lessee. And sometimes the asset remains with the lessor, but the lessee got the right to direct what, when, and how to use. So that contract will also be a lease. Like in case of satellites, in case of fiber optic, in case of IPPs, we have these types of contracts under which the lessor, basically you can have the possession of the asset, but the right to use the asset rests with the lessee. So when we talk about economic benefit, how the lessee will get the economic benefit, that will be either through obtained directly or to direct the lessor for the use of the asset. Both will be, you can say, in both the cases, we can say the lessee has a right to get benefit. There's a very important area which is given in red, and that is substantive substitution rights. Sometime in the lease contract, the lessor also undertakes that in some circumstances, the lessor can change or exchange the asset. So it's very important when the lessor has such a right, or the lessee has such a right, that there should be a substitution of the asset, whether that asset remains an identifiable asset or not. So this standard basically restrict that if there is a substitution right exists with the lessor, or the lessee can require the substitution of the asset. So whether that contract still be a lease of a identifiable asset or not. So this is very important part of the standard, substantive substitution rights. If the substantive substitution rights exist in the contract, then if supplier's practical ability through the lease term, the lessor has the practical ability to substitute the asset during the lease term, and the supplier or the lessor basically has a benefit and which exceeds its cost to substitute the asset. If those two conditions exist, then it means that this lease contract is not of a identifiable asset, and it's basically a servicing contract. Like, let's say if a railway has, you can say, lot of you can say certain you can say material carriages available, but the railway can, you can say, substitute the engines and the, you can say, railway carriages. So if such a right exists with the railway, and you cannot identify which engine or which, you can say, carriage will be available to the, or will be, you can say, identified for the lessee, then this contract will not be a lease. Basically, the lessor has a substantive substitution right. So it's very important in identifying the lease contract, you have to identify what substitution rights rest with the lessor. So when we talk about the right to obtain substantially all of the economic benefit, that should be an exclusive right, including its primary and primary output and secondary or byproducts. And if we talk about the right to direct the use of the asset, decision about why and how the asset should be used, that should rest with the lessee. And then if there are certain protective rights, like there should be certain, you can say, repair and maintenance break available to the lessor, such right will not, you can say, impair the definition of lease. That will remain a lease contract under IFRS 16. This is basically a decision tree given under IFRS 16, whether the contract is covered under the lease under IFRS 16 or not. So first of all, the question is there an identifiable asset? If the answer is no, it's not a lease contract. Like, let's say, basically the lessor or the, you can say, vendor undertake to provide conveyance to the customer, and there is no identification of the asset which will be used to, you can say, provide the service. That will be basically service contract, that will not be covered under IFRS 16 as a lease. And then if there is an identifiable asset, the answer to the first question is yes. Then the right to obtain substantially all of the economic benefits. Then the second question will be whether the customer has a right to get all of the economic benefit. If the answer is no, then again it's not a lease contract. If the answer is yes, then the next question is the right to direct the assets usage, and who will be having the right to direct the usage. If the right to direct is with the customer, then it's a lease contract. If the right exists with the supplier, then it will not be a lease contract. If there is no identification who can direct the usage of the asset, then there is another question, the right to operate the asset. If the customer can operate the asset, then this is a lease contract. If there is no specific information given in the contract, then the last question is, did the customer design the asset? Sometime even before the lease contract, the lessee direct how that asset should be manufactured or developed, and then it means it will be a specified asset for the lessee. If such a situation exists, then it means it's a lease contract, and that will be covered under IFRS 16. If the answer is no, then it's not a lease contract. So it's a very important decision tree to identify whether the contract is a lease or not. We have certain examples on these areas. First of all, what is meant by identified, and then what is not identified. These examples are given in IFRS 16. Here is an example of a coffee company enters into contract with an airport operator to use a space in the airport to sell its goods. Okay, it's a, you can say, coffee shop operator, and is trying to get space on an airport. If there is no specific, you can say, area identified for this shop, and it's only provided that you can use, let's say, 10 by 10 foot in any area of the, you can say, airport, and the vendor or the airport authority has a right to, you can say, change its space whenever that airport authority, you can say, have another usage for that part of the airport. So it's not a lease. But if it's a specific area and there are no substantive substitution rights with the airport authority, then it will be a lease contract. Here is another example. Customer enters into a 15-year contract with a utility company for right to use 3 specified physically distinct dark fibers within a large cable connecting Hong Kong to Tokyo. Here is a lease of a fiber optic. If you can say you have identified that these 2 fiber optic cables or 3 fiber optic cables will be, you can say, identified, and they will be providing, you can say, whole of the traffic to a specified customer, then it will be a lease. But if you are, you can say, not, if there is no specification which fiber optic will be used to transfer the customer's data, and you are only providing a service that the customer's data will be transmitted through the fiber optic, that will be a service contract. And then there is another example. Customer enters into a 15-year contract with the supplier for the right to use a specified amount of capacity within a cable connecting Hong Kong. जैसे अभी हमने बात की है, ये उसी की एक extension है कि if you are only undertaking that you will be providing service to transmit a data from one location to the other location, and there is no specific identification which fiber optic will be used, that will not be a lease contract, that will be basically a service contract, and that will be covered under IFRS 15, not IFRS 16. Here are some key terms used in the standard. First of all, inception date. Inception date means the date on which the lessor and lessee agrees upon the major terms and conditions of the lease is called as inception date. It can be the agreement date, it can be even before the agreement date. And then we have commencement date. It's basically the date on which the lessor conveys the right of use of asset to the lessee is called as commencement date. The basically accounting starts from the commencement date. And then we have lease term. It's a very important definition, and it's not different from the definition being used in IS 16. Is a non-cancelable period of the lease. And then terms of the contract and enforceability. Basically, it's an enforceable period. It's an enforceable period under the lease contract. Enforceable period means under the lease contract, basically the lessee or the lessor has basically the right, or you can say the lessor has the right, then it has a right to direct the lessee for a specific period. And if the lessee, let's say, want to cancel that period, it has to pay certain damages to the lessor. So enforceable period means that period which can be enforced under the contract, and if any party, let's say, violate that contract, or let's say terminate that contract within that period, it has to pay certain damages to the other party. And then period covered by an option. Sometimes the lessor gives the right to the lessee to extend the lease. So if there is an extension option given in the lease, then if it's reasonably certain that lessee will avail this option, then that optional period will also be part of the lease term. But it's very important, under this standard, this optional period will always be assessed at each reporting date. And there is any change in the, let's say, option to extend the lease, then that will be called as reassessment under this IFRS, and you will be accordingly, you can say, changing the values of your right of use and lease liability, you can say under IFRS 16, and adjusting the values of right of use and lease liability. So then there is a third part, period covered by an option to terminate. Sometimes there is an enforceable period, but the lessee can, you can say, terminate before the end of that period. So if the lessee has the option to terminate in some part of the enforceable time, then that will be called as option to terminate the lease contract. And if it is reasonably certain that lessee will not avail that termination option, that will be, you can say, part of the lease term. But it's very important that termination is normally not to be opted by the lessee. If there is a cost involved, it has to pay certain damages, or you can say the asset is very important, or you can say its business depend on the usage of that asset. In those circumstances, then you will say that this termination option will not be availed by the lessee. It's very important. Ji. Maybe if there is a bullet payment option, or the lessee has a right to cancel the lease by making, you can say, whole of the payment before the expiry of the lease term, then it's very important that what are the facts and circumstances of the, you can say, of the lessee, and also you can say whether the lessee will be availing this option or not. But it will not impair the definition of lease. It will remain the part of the lease term unless the lessee exercise the option. Let me explain in more detail that sometimes the lease contract is not enforceable at all. The lessee and the lessor both can terminate the lease contract at any time, you can say, without any penalty. Such a contract will not be, you can say, considered as you can say, that will not be considered as having a valid lease term. That will be normally accounted for under exception accounting under IFRS 16 for the lessee. Sometimes the lessor has the option to terminate the lease. IFRS 16 says if the lessor has the option to terminate the lease, then that will not be considered in determining the lease term. If the lessee has the option to terminate the lease, that will be part of the lease term if it is reasonably certain that lessee will not avail the option. And that will be the case where there are certain damages involved, or there are certain, you can say, dependence on the asset involved. In those circumstances, the lessee may not be in a position to exercise the termination of the lease. But in case of bullet payment, you will always be identifying that what period you will be considering after which you will make a bullet payment. So that's why there's always involve a, you can say, determination of lease term at the, you can say, end of each year, that if there is any change in your estimate, you can accordingly accommodate and make your value of lease liability and right of use accordingly, you can say, in the books of financial statements, in the books of the financial statements. Anything else? It's a very important component, and most of the people get confused in the definition of the lease term. Okay, let's answer all these questions. There is a comment that they are not properly listening to the presentation. There's some problem. And then we have it's very difficult. Okay. There is a question in the chat box, sir, what if there is an obligation to use an asset? Will it be a lease? For example, government leases out an asset as subsidy to company with an obligation to use that asset. Basically, these types of contracts are normally BOT arrangements, and they will be covered under IFRS 12, not under IFRS 16. And then some comment is, please use the term lessee and the lessor. First of all, we have to identify whether this contract is a lease or not. And then if this is a lease, then we can use the word lessor and the lessee. Otherwise, we will be using the word customer and the supplier, because then that contract will normally be covered under IFRS 15.
Month or 3 months. Whether the leasehold improvements trigger that lease to be accounted for as a long-term lease.
Basically, in the basis of conclusions paragraphs and in the application guidance in IFRS 16, always remember there is a legal form of the contract and there is an economic form of the contract. What International Accounting Standards Board members basically require that you have to judge the lease term on the basis of the economic reality of the transaction. If there are certain leasehold improvements which will be providing economic benefits for more than 1 year, and you have also the intention to continue, and there is a heavy cost involved if you, yes, let's say, terminate the lease, then it will be a lease, and that should be accounted for as a lease under IFRS 16, and there should be a reasonable period assigned for the renewal as well. That's why a renewal to extend the lease is also included in the definition of lease term.
Okay, sir. Secondly, sir, you are asking that if it is reasonably certain that the lessee will avail this option. Reasonably certain mean it is intent of the lessee, or whether certain factor have to be considered?
No, it's not just the mere intention of the lessee. It's basically sometimes the compulsion for the lessee as well. Like, let's say it's business heavily dependent on the operation of that asset, then it's a compulsion, it's not an intention. So that's why I use the word facts and circumstances.
Facts.
That when deciding the lease term, you have to identify the facts and circumstances, and accordingly, you should determine the lease term.
Okay, sir. And last question, with respect to lease commencement date, a lessee has made a contract with the lessor, and the lessor has provided a grace period of 7 to 8 months.
Grace period is also part of the lease term. In the grace period, you will also account for the lease, and there will be certain, you can say, present value complications, but there will be no exception that is part of the lease term, that grace period is included in the lease term.
Okay, sir. It means that if the grace periods ends after the reporting date, and my reporting period ends before starting the rentals, it means
you have to account for
it,
because
means there, at the reporting there is a right,
yes,
right
that's,
of use.
that's why the word commencement date is being used.
Okay.
Commencement date means if the right of the use of the asset is granted to the lessee,
Yes.
it means you have to start accounting for the lease.
Okay, thank you, sir.
Any other questions? There is a question in the chat box that there is no minimum enforceability period. Yes, then it's not basically you will not be going for accounting of lease for the lessee as far as the lessee is concerned. That will be an exception accounting.
Yes, sir. A little question is that sometimes it is usually practice of the lessee or the agreement between the lessee and lessee that 3 months advance rent is to be paid on after every 3 months. Whether this advance rent of 3 months will be accounted for as a one bullet payment, or I have to take it on every month while calculating present value of.
Basically, it depends on your accounting. If you are doing monthly accounting, then you have to go for you can say monthly recognition of accounting entries. If you are not incorporating you can say monthly accounting, then you will be normally accounting at the end of 3 months. But normally question arises when there is a year end between the, you can say, payment and the accrual of the lease payments. Then you simply account for or accrue the rentals payable.
or otherwise as prepaid rent?
It's not called bullet payment. It will be basically the cycle of the lease payments. It's not a bullet payment. Bullet payment means that sometime in a lease contract, the lessee is given the right to make principal payments other than the normal rental. That is called basically the bullet payment. That's in normally you can say under a certain Islamic mode of financing, where we use certain ijara transactions or diminishing musharaka transactions. Then those banks which are providing Islamic financing do allow the lessee to make a bullet payment without any charges, and that is basically some percentage of the principal amount, and then your rental accordingly adjusted.
Okay. Sir, if as you are saying that if your accounting cycle is monthly, and I have prepaid a rent of 3 months, for example, I have prepaid a rent of 3 months in May, and my accounting period ends on June, and at the June 2 months rent is a prepaid rent.
Prepaid rent.
In case of monthly accounting, I will account for 2 months rent at advance.
Basically,
sir,
first of
when-
all, it depends whether you are doing the accounting of lease or basically you are doing exception accounting. If you are doing exception accounting, then it will be a prepayment. But if you are doing lease accounting, it will be simply an accrual of interest because you have already recognized the lease liability and right of use. So it depends what accounting you are using. If you are using exception accounting, then this is an issue. If you are using lease accounting, then it's
what
not
is
an
the
issue.
difference between exception accounting and lease accounting?
Just give me a few minutes. I will provide the
Okay.
information. Okay.
And sir, a second question is that when I take, when I work out the present value of rentals, if I made a payment as advance of 3 months, whether it is rational to take it as one payment or at the end of every month, because we calculate the present
It
value
should
of.
be. There's no option. It should be. Your payment cycle should remain intact. Otherwise, your present value calculations will be totally wrong.
This is the question.
Yes. And that will be only the issue if you are recognizing it a lease. If you're not recognizing it a lease, you are following exception accounting, then it's not an issue.
Okay.
Let me give
Okay, sir. Thank you.
No problem. No problem. Here we have the definition of lease payment. Payment made, okay, one thing remain, and that is basically in case of long-term leases, like 99-year leases, or you can say 30-year leases or 50 years leases. IFRS 16 provide that it can be accounted for under IFRS 16 or it can be accounted for under IFRS 16. So in case of long-term leases, and particularly in case of land and building leases, you can go for IFRS 16 or IFRS 16. And that is basically just, you can say, the definition of lease term we were explaining. And then we have the definition of lease payments. Payments made by lessee to a lessor for the right of use of an underlying asset during the lease term. So it's basically an overall definition, but the components are fixed payments. Also, in substance fixed payments, sometimes the payment is variable, but an underlying variable is, you can say, such a variable which is not expected to occur. So that kind of variability will not be considered, and that you can say part of the rent will always be considered as a fixed payment because that underlying variable is not expected to occur. So that is why in substance fixed payment word use, less any lease incentives, like you mentioned the grace period. So grace period is a lease incentive, and then variable payments depending on index or rate. As all we know in Pakistan are basically leases are based on KIBOR. So there will always be an adjustment of the interest rate after 3 months or 6 months or after 1 year, and that will change your, you can say, the lease rental. That part of the lease rental, which is being, you can say, changed because of the change in the index or rate, that will be called as variable part of the lease payment. It's very important that there are only two variables are considered as part of the lease payment. One is the index, like certain inflation index, certain, you can say, other indexes like, let's say certain stock exchange indexes can also be used, certain, you can say certain other parities can be used, and then rate, which is basically normally the interest rate. And then include at prevailing, it's very important that as we know that there will always be change in the index or the rate, and the rental will get variable, but your present value calculation will be based on the current situation. And if the, you can say, index or rate changes and your rental become, you can say, different from the previous rental, then you will assume that this rental will remain for the future periods. So there's no need to forecast, or you can say identify what will be the index or what will be the change in the rate. You will use the existing rate or the existing index to determine the value of the rental, and then if there is any change, you will be accordingly changing the rental, and then you will be assuming that in the future periods it will remain the same, which is your current index or rate. And then exercise price of purchase option. Sometimes the lessor give the right to the lessee that the lessee can purchase the asset at the end of the lease term, then the bargain purchase price will also be part of the lease payment. But if it is reasonably certain that lessee will avail this bargain purchase option. Again, we have identified what can be the different circumstances under which we can assume that lessee will avail this option. And then we have penalties for terminating the lease. This will be only relevant when the lessee has decided that it will terminate the lease. So when lease term is being adjusted because the lessee is going to, you can say, opt for the termination of the lease, then there will be a termination penalty, which will become part of the lease payments. And then there's a very important point, and it's a residual value guarantee. Now there is a different concept of residual value guarantee, when that will be part of the lease payment or not. Previously, for the lessor and the lessee both, it was given in the IS 17 that if there is a guaranteed residual value by the lessee or by the party related to the lessee, that was considered for the lessee, and for the lessor, a guaranteed residual value was part of the, you can say, lease payment if it's granted by the lessee or by party related to the lessee or any other third party. But now the concept is entirely different. Now the residual value guarantee, if part of the lessee accounting, is the situation under which the guaranteed residual value exceed the expected residual value of the asset, and that excess portion will only be part of the lease payment. Let's say the lessee guaranteed that at the end of the lease term, or its party related to the lessee, you can say guaranteed that at the end of the lease term, this asset will be having 10,000 value. It's a residual value, and it has guaranteed, let's say, 15,000. Under the contract, it has granted 15,000, but expected residual value is only 10,000 of the asset. Then that 5,000 will be basically considered as a guaranteed residual value, which will become part of the lease payment. Now it's a different component, and if you, let's say, estimate that the residual value is, you can say, more than the guaranteed residual value, there's no need to add guaranteed residual value portion in the lessee accounting. But for the lessor, the concept is the same that was previously given in IS 17. Okay, so next we have is lessee accounting. No classification of lease by the lessee. At the commencement date, it will recognize the right of use of asset and lease liability. First, it will determine lease liability. Lease liability is basically payment of unpaid renters, present value of unpaid renters. So it's very important that advance payment is not part of the lease payment. Lease liability is present value of unpaid renters at the commencement date. And on the other side, right of use will be amount of lease liability, which we calculated under the heading lease liability, plus lease payment before on commencement date, means advance payments, and then initial direct cost, and then estimate of dismantling cost. If the lessee is required to dismantle and restore the site at the end of the lease term, then that dismantling and site restoration cost will also become part of the lease right of use. And then when you take the present value of lease liability, you will use interest rate implicit in the lease if it is provided by the lessor to the lessee. If not provided by the lessor to the lessee, then lessee will use its own incremental borrowing rate. Then no classification of lease, as we already said, and then we will recognize right of use and lease liability. But there is an exception accounting by the lessee. If lease term is less than or equal to 1 year, it will be a short-term lease, and you can go for exception accounting. Or the underlying asset is of low value, it will be a materiality concept, and every entity will determine its materiality level and accordingly determine whether it's a low value lease or not, and then accordingly it will apply exception accounting. In exception accounting, there will be no recognition of right of use or lease liability. It's basically lease payments will be divided on a straight line basis over the lease term. Then you will be recognizing only a rental expense if you make the payment. Then you will credit bank, otherwise you will credit payable or accrued expense. Okay, if you are doing lessee accounting, but you have came across certain variable lease payments, and then what to do with the variable lease payments? Do they depend on the index or rate? If yes, then that variable part of the lease payment will become part of the lease accounting. If it is not because of the, you can say, index or rate, then it will be excluded from the lease accounting. It will be simply recognized as an expense or income by the lessee or by the lessor. If the answer is yes, include in the lease payments, measure the rate prevalent at the measurement. Okay, we will deal with this in, you can say, an example. Okay, initial direct cost. Initial direct cost will be part of the right of use if it is incremental in nature. If it's not incremental in nature, then it will not be part of the, you can say, right of use. And if the lessor accounting is concerned, if it's a manufacturer or dealer lessor, then it will be expensed out. Otherwise, it will become part of its net investment in the lease. Examples are legal fees, commissions, but internal cost and certain legal advices or certain recurring charges will not become part of the initial direct cost. Discount rate. If the lessor's rate is available, then lessee will also use this rate to calculate its present values. But if lessor's rate is not available, then lessee will use its own incremental borrowing rate. The interest rate implicit in the lease is also, you can say, defined in IFRS 16, and it's defined from the lessor's perspective. And that perspective is, if the present value of lease payment plus present value of unguaranteed residual value, this will become gross investment, is equal to fair value of underlying asset plus lessor's initial direct cost. So it's basically an equation. You determine the fair value of the asset and you determine the lessor's initial direct cost. It will become lessor's investment in the lease, and then you discount at that rate of interest, which will make future receipts exactly equal to the fair value of underlying asset plus lessor's initial direct cost. That rate will be called as interest rate implicit in the lease, and that is also called as IRR. Okay, then we have a lease accounting by lessee. Subsequent accounting, right of use will be depreciated in the books of the lessee, and then lease liability will be, you can say, recognized on a present value, but there will be certain unwinding concepts. You recognize interest on lease liability, make lease payments. IS 17 was slightly different from IFRS 16. This standard required that you accrue the interest and add that in the value of lease liability. And then if you have made the payment, then debit the lease liability and credit the bank account. So it gives a constant periodic rate of return to the lessor as well. And if you are accounting for right of use asset, then you will determine whether it's your asset covered under IS 16. Then both the models are available, cost model and revaluation model, depending that what model you are using for related assets, which are your owned assets. And then if this is basically an investment property, then you all know that investment property has two models. One is cost model, which is similar to IS 16, and then there is a fair value model. Then you will be accordingly apply a fair value model if on the right of use, if you are, you can say, following a fair value model for owned properties. And then there will be also impairment testing under IS 36. Okay, before going for reassessment and modification, let's have some Excel examples. First of all, as we said that there may be certain lease and non-lease components. In case of lease and non-lease component, I think you have gone through IFRS 15 in the last week. The method is same, that you will be allocating the lease payments according to the relevant standalone selling prices of different components. It means that if there is a lease component and there is a non-lease component, the allocation of the lease payment will be according to the standalone selling prices. So this is an example which we will be sharing with you, and there is a solution as well, but I think we don't have the time to go through all these areas. And then we have initial measurement areas. Okay, we go through this example. Lessee enters into 10-year lease of a floor of building with an option to extend it for 5 years. Lease payments are 50,000 per year during the initial term and 55,000 per year during the optional period, all payable at the beginning of each year. To obtain the lease, lessee incurs the initial direct cost of 20,000, of which 15,000 relate to payment to a former tenant occupying the floor of the building, and 5,000 relates to commission paid to the real estate agent that arranged the lease. As an incentive to lease, for entering into the lease contract, lessor agrees to reimburse to the lessor the real estate commission of 5,000 and lessee's leasehold improvements of 7,000. So it's very important that this 5,000 is an incentive, but this 7,000 is not an incentive. It's basically, you can say, a payment against the leasehold improvements, which is basically IS 16 area, not IFRS 16. At the commencement date, lessee concludes that it is not reasonably certain to exercise the option to extend the lease, and therefore determine that the lease is 10 years. So there is an optional period, but we will not be considering it. Okay, then information is given that lessee's incremental borrowing rate is only available, which is 5%. And then there is a second part of the question, which will be, you can say, change in the lease term, which will be dealing later on. But let's have, you can say, the initial accounting. And this will be your initial accounting. You will determine right of use, which is basically, you can say, this lease payments, the present value of lease payments, amount for lease liability or any advance, then initial direct cost, and then estimation of any dismantling or site restoration cost. So here is a present value of the lease liability. And then there's a cash payment, and then right to use asset. And then we add the initial direct cost. And then we have deducted the incentive from the right of use. And then this is your present value calculation. This is your present value of lease liability. You accrue the interest as rental is in advance. Then at the end of the year, you only accrue the interest. Then this is your lease liability at the start of the next year. First, you paid the rental and then you accrue the interest and so on. And similarly, you have this value of right of use, and then you are depreciating this asset over, you can say, the lease term or the useful life, depends whether you have the bargain purchase option and you will be going to exercise that bargain purchase option, or there is a revert back contract. If there is a revert back contract, then you will be depreciating the asset over its lease term. And if you having the bargain purchase option and it is reasonably certain that you will avail the bargain purchase option, then you will be depreciating the asset over lease term or useful life, whichever is lower. So here are the certain accounting entries you will pass in the recognition of the lease and right of use. And then we have this part of the standard, which is basically reassessment. What is reassessment? Reassessment basically that part of the lease contract which you initially determined in a different way and then subsequently you came across with a different conclusion. So that will be called as reassessment. It is different from modification. Modification is basically something new in the contract, and reassessment is basically the reassessment of those terms and conditions which you initially followed in a different way, and on a subsequent date, you have decided to follow on a different manner. So that will be called as reassessment. So reassessment can be in the form of lease term. It can be in the form of a bargain purchase option. Initially, you decided you will not avail the bargain purchase option. Subsequently, you decided that you will go for the bargain purchase option. And then there is a termination option in the contract. Initially, you decided that you will not be going to terminate. Subsequently, you decided that you will be going to terminate. And then there's also an area where you can say the interest rate changes or certain, you can say, index changes, and you have to reassess the value of the rental. Those all will be called as reassessments. And then there is a guaranteed residual value from the lessee's perspective. Let's say initially the lessee was of the opinion that the residual value will be more than the guaranteed residual value. There's no need to add something in the lease payments. Subsequently, it determines that the guaranteed residual value is more than the expected residual value of the asset. So it's going to add some part of the guaranteed residual value in the lease payments. All these will be called as reassessments. These are called reassessments. Now the question is whether reassessment will be at a new discount rate or it will be at the old discount rate. So here is a decision tree. After the commencement date, lessee remeasures lease liability and then as an adjustment to right of use. As clear from the presentation that first you determine the lease liability, you will compare the new value of the lease liability with the carrying value of the lease liability. The difference, if there is any, that will be adjusted with the right of use. So, but it's very important that sometime if there is a reduction in the lease liability and you reduce the value of lease liability and you credit the right of use and you come up with the conclusion that asset has become zero, and then the excess amount will be charged to profit or loss account that will not be credited to the asset. So that's why not below zero is mentioned in the slide. So what discount rate you will use to determine the new value of lease liability? So there is a revised discount rate at the time of reassessment or the unchanged discount rate, which you have basically determined at the commencement date. So if there is a change in the lease term or there is a change in option to purchase the asset, initially you decided that you will go for the bargain purchase option. Subsequently, you decided that you are not going to go for the bargain purchase option or vice versa. So you will use the new discount rate, and the discount rate will be unchanged if change in the residual value. As I already mentioned that initially you said that your residual value of the asset is more than the guaranteed residual value or equal to the guaranteed residual value. So there's no need to add something in the lease payments. Subsequently, you come up with the conclusion that guaranteed residual value is more than the residual value, and now you are going to add something in the value of lease payments. So that will be, you can say, reassessment of the lease payments. But you will use the unchanged discount rate, and then if there is change in future payments due to index or rate, your interest rate will remain the same. किस वजह से चेंज हो रही है? इंडेक्स और रेट की वजह से चेंज हो रही है, ठीक है ना? जी जी. Okay, let's have the example. Second part of the example, basically, here. In the 6th year of the lease, lessee acquires entity A. Entity A has been leasing a floor in another building. The lease entered into by entity A contains a termination option that it is exercisable by entity A. Following the acquisition of entity A, lessee needs 2 floors in a building suitable for the increased workforce. To minimize the cost, lessee enters into a separate 8-year lease contract for another floor in the building leased, and that will be available for use at the end of year 7. That is basically for its subsidiary. And now the B part, terminate early the lease entered into by, again, it's for the lessee. Consequently, at the end of 6th year, lessee concludes that it is now reasonably certain to exercise the option to extend its original lease as a result of its acquisition of entity A. So now it has decided that basically it is now going to avail the next 5 years as well. So it's a change in the lease term. It's a reassessment in the lease term. So as we discussed in the slides, here are your, you can say, end of 6 years. This is the value of right of use. This is the value of lease liability. And in the, you can say, start of 7th year, you are going to reassess the lease. So here is a discussion given, but the important thing is you calculated the value of lease liability with the new, you can say, a lease term, and you have also changed the interest rate. Here is a calculation. At the end of the 6th year, before accounting for the change in the lease term, the lease liability is 186,162. The present value of 4 remaining payments of 50,000 discounted at the original rate. Interest expense is 8865 is recognized in year 6, and lessee's right of use is 168. Lessee remeasures the lease liability at the present value of 4 payments of 50,000 followed by a 5 payments of 55,000, all discounted at the revised discount rate of 6%, and then you come up with the value of 378,000, and your carrying value of lease liability is 186,162, and there is a difference of 192,000, and you adjusted the value of right of use and lease liability, and onward you change the interest rate. As you see, here is a 6%, and here was 5%. So this is basically the accounting for reassessment of the lease. Any question?
Sir, reassessment is required at the reporting date or when facts and circumstances
Any
has been
date,
changed?
any date. When your facts and circumstances are changed, if that is during the year, you have to accordingly account for during the year.
Secondly, sir, in the current economic scenario, as the interest rates are highly volatile, whether it is practicable to reassess whenever interest rate changes?
No. When basically there is a change in interest rate cycle determined by the lessor, that after 3 months, 6 months, or 1 year, accordingly you will revise, not at your you can say intention or your calculation.
Sir, those leases which have been accounted for in 2020 at 8 or 9% or 10%, now the interest rate is almost doubled. Whether this triggered to for reassessment of the lease?
Yes, it is a reassessment, but if that is based on a variable rate, it is a reassessment. You have to, no option.
But sir, in case of volatile interest rate, it means there is a requirement to reassess.
That's why banks are
Please.
going for variable rate. That is why this volatility is being reflected in their, you can say, agreements.
And sir, sometimes it is very difficult to identify the discount rate. Normally,
No, it's
market
not.
rate is
It's
strict.
not. It's not. Just an effort is required. If you simply send an email your banker that you are interested in other, let's say, similar car with a
Yes.
similar lease term, you will get a reply very soon, because there is no there is no, you can say, leasing being done by the banks nowadays. So you will get within few hours, no problem.
But sir, in case of if we have taken head office on rental and it is a long-term lease, then can we use the market rate as an incremental borrowing cost?
I don't think so, because the standard says it's a lessee specific rate. It cannot be a market rate. It's a lessee's incremental borrowing rate. Market rate is not warranted under IFRS.
But sir, in case of private limited companies, it is very difficult to work
I don't
out.
think so. You send an email, you will get a reply
Okay.
within few hours, guaranteed.
Okay, sir.
Okay, ji.
Okay. Lastly, sir, initial direct cost. In case of vehicles, registration of the vehicle is in the name of the banks, and that cost is reimbursed by the client. And what should be the treatment of
That is
this
basically of the
registration?
lessee, not the lessor. It's the lessee's initial direct cost.
Whether it would be accounted for as ROU's part,
If it is reimbursed by the lessee, it's a lessee's cost.
lessee's cost. Is it IDC?
Yes, it's the IDC.
Yes. If it is IDC, then in cash flow, whether it will be disclosed or presented under investing activities?
That's, it is part of the right of use, so it will be part of the investing activities.
Okay. Sir.
Okay, let's have another example. Lessee enters into a 10-year lease of property with annual lease payments of 50,000 payable at the beginning of each year. The contract specifies that a lease payment will increase every 2 years on the basis of increase in customer's price index for the preceding 24 months. The consumer price index at the commencement date is 125. This example ignores any initial direct cost. The rate interest rate implicit in the lease is not readily determinable. Lessee's incremental borrowing rate is 5% per annum, which reflect the fixed rate at which lessee could borrow an amount similar to the value of the right of use in the same currency for a same term. It's very important. It's lessee specific. Lessee expects to consume the right of use assets, future economic benefits evenly over the lease term, and thus depreciates the asset right of use on a straight line basis. At the beginning of third year of the lease, the consumer price index is 135. So you have to recalculate the rental. There is initial accounting. You debit right of use and credit lease liability and accordingly advance payment. And then you accrue certain interest expense and charge depreciation on a straight line basis. And then you make the second payment. And now at the start of the third year, you at the end of the second year or at the start of the third year? Okay. So here is a recalculation. At the beginning of the third year, lessee remeasures the lease liability at the present value of 8 payments of 54,000, discounted at unchanged discount rate. Now the rate will not change. And now the value is 3,66,464. There is a carrying value given over here. Here is a carrying value, 339, 319, and the difference is basically 27,146. So there is an increase in the lease liability. Right of use asset will be debited and lease liability will be credited with the change in the value of the lease liability. Okay. So here is a reassessment. Any question on reassessment? अच्छा ब्रेक ले ले असर की, ठीक है जी। ओके, रीअसेसमेंट वी आर डन विद। आगे जो है वो मॉडिफिकेशन है, तो मेरा ख्याल नमाज की ब्रेक कर लेते हैं। दिन से आधा हो रहे थे, कट कर दी। The current start. Okay, ji, let's start again after the namaz. Accounting by lessee, we are continuing. Now we are going to discuss lease modification. What is lease modification? A change in the scope. It means that asset under lease is basically is going to change. There may be increase in the scope or there may be a reduction in the scope of the asset or consideration. There may be change in the lease payments, and that was not part of the original lease. At the time of the original lease contract, this was not part, and now it's being made, you can say the changes being made in the lease contract. So first of all, we have to identify whether this modification will be part of the existing lease or it will be, or the modified part should be accounted for as a separate lease. Are the rights added to the lease contract to use one or more underlying asset? If there is an increase in the scope of the asset, you are, let's say, leasing 100 square feet and now you are going for another 100 square feet, clear? Or let's say you are having a certain, you can say, area of land and now you are going to increase the area of land, that type of you can say change. If the answer is yes, does the consideration increase commensurate with the standalone selling price? The additional part or the addition in scope is also, you can say, attracting the additional price which is based on standalone selling price. It's a market price now. There's no, let's say, incentive that you are already leasing some part and now you are going for another part. There's no incentive, or there's no, you can say, additional payment being made. That is the additional part is also attracting the additional rental, and the additional rental is standalone selling price. If the answer is yes, then the additional part or the increase in scope of the asset should be accounted for as a separate lease. The new lease contract or the additional part of the contract will be, you can say, new lease, and there will be no change in the accounting of the old, or you can say old asset or the old part of the lease contract. If the answer to the first question is no, it means there is not an increase in the scope. It is basically a reduction in the scope, or there is a change in the price. All these, you can say, areas will be resulting in a no answer to the first question. Then it's a lease modification. Clear? It means this modification is part of the existing lease contract. If the answer to first question is yes, but the standalone selling price is not being charged for the additional part of the asset, then it will also be part of the existing lease contract, and that will also be accounted for as a lease modification in the existing lease contract. So if there is an increase in the scope and the price for the increased scope is also based on the standalone selling price, then it will be a new lease. Otherwise, the additional part will be a new lease. Otherwise, in all the circumstances, if there is a change in the price, there is a change in the lease term, there is a reduction in the scope of the asset, that is basically a modification, and that will be part of the existing lease contract. There is an exception for COVID-19 years. There were a lot of incentives given by the lessors to the lessees during the COVID-19 period. So there are certain, you can say, additional paragraphs under the heading of modification. And if incentive is being given because of the COVID-19 situation, then it's an exception to the modification, and you will go for reassessment accounting. So if there is an incentive in the lease, there is a change in the lease payment because of the COVID-19 situation, although it's a modification of the lease contract, but it will be accounted for as a reassessment, or its accounting will be reassessment, that the change in the rentals will be, you can say, change in the value of the right of use and the lease liability, as we already discussed in the previous slides. Okay, what to do with the modification? Part of the original lease, it means you have to remeasure the lease liability, you have to address the carrying value of right of use, you will be adjusting the value of lease liability, you will be adjusting the value of right of use, and there will be some component will be going to profit or loss as well. So we will be discussing the different scenarios, whether it's a change in the scope and that is not at standalone selling price, then what to do. If there is a change in the lease term, then what to do. If there is an increase in the lease term, if there is a reduction in the lease term, then what should be the accounting of these situations, we will discuss in the later slides. And then if it's a separate lease, it means there's no adjustment to the existing right of use and existing lease liability. The additional part of the lease contract will be accounted for as a separate lease, as we already said, what accounting we have to do at the commencement date, and what should be the different interest rates to be used, or what will be the subsequent measurement, we have already discussed. Now, lease modification. So we will be, you can say, discussing each and every situation, and we will be also discussing the examples as well. If there is a reduction in the scope of the asset, let's say you are having 500 square feet area, and now you are going to have 200 square feet area. So it means there is a reduction in the scope. You have reduced the, you can say, the right of use, you can say the portion of the right of use has been significantly reduced as compared to the previous lease contract. So what you will do? The standard says you will reduce proportionately the right of use. As I already said, let's say this was 500 square feet, and now you are only going to have 200 square feet. So what portion you are going to de-recognize at the modification date? You will be having a carrying value of the right of use at that date, and now you will be having only 2/5 of the right of use. You are going to forfeit 3/5 of the right of use of asset. So you will reduce proportionately. What it means? Carrying value of the right of use multiply by 3/5, you will de-recognize that portion of the right of use. So right of use will be corrected by carrying value multiplied by 3/5. And then what you will do with the lease liability? So lease liability is basically also reduced, but the problem is the lease liability will be reduced by 3/5, but the portion will be slightly different, because lease liability is being measured under present value calculations, right of use is being depreciated on a straight line basis or some other, you can say, depreciation method. So there will not be a same change in the value of lease liability and right of use. So you will also multiply 3/5 with the value of carrying value of lease liability, but the figures will be different. The reduction in right of use will be different from the reduction in lease liability. The difference will go to profit or loss account. And then there is another part, and that is you will now get the present value of remaining lease payments at a new discount rate, and whatever the change in the revised carrying value because of this present value will be adjusted with the carrying value of right of use and lease liability. So there will be two steps. One is reduce the carrying value of lease liability and right of use, and then recalculate the present value of lease liability using new discount rate, and the change in the revised carrying value as compared to the new present value at the new discount rate will be adjusted with the right of use and lease liability. So there will be two steps involved in this area. Got the point? Will be slightly. Sorry? No. You will credit right of use, debit lease liability, the difference will go to profit or loss. Yes. And then you will remeasure the lease liability at the new discount rate. It should be remembered that modification, at the date of modification, you will determine a new discount rate. and your new liability at the modification date will be at a new discount rate. And now you will calculate the present value of remaining rentals which are revised at a revised discount rate, and there will be a carrying value of liability. You compare the carrying value liability after reducing it proportionately, and then the change in carrying value and the new present value will be adjusted with the lease liability and right of use. Okay. Then if a reduction in lease term, if there is a reduction in lease term, let's say it was 10-year lease, and now after 2 years, you are going to reduce it, let's say at 7 years lease. So after 2 years, previously there was, let's say 8 years, and now there are only 5 years. So there is a reduction in the lease term. In this scenario, you will also reduce the carrying value of the right of use proportionately. How many years have been deducted from the lease term? 3 years. So previously it was a 10-year lease. Now it's a 7-year lease. What you will do? You will proportionally reduce the carrying value of right of use. So 3 by 10. Sorry, not 3 by 10. The remaining part. Remaining is 7 years, and originally 10 years, and now the total lease term is 7 years after 2 years. So the remaining are 5 years. So right of use will be of remaining 5 years should remain. Or before modification, it was 8 years. So now it will be 3 by 8. It will be de-recognized. But in case of lease liability, there is a problem. Now you have the carrying value, which is based on remaining 8 years present value, but you only need present value for 5 years. So you will calculate the present value of lease liability, old rental with old discount rate for 5 years, compare with the lease liability carrying value and reduce it by 3 years. Then again, you will debit lease liability, credit right of use. The difference will also go to profit and loss account. And then you will calculate, again, you will calculate the lease liability at a new discount rate, remaining cash flows at new discount rate, and compare with the adjusted carrying value. The difference will go to right of use and lease liability. It's a very tricky area. So we will be having examples as well. And then the next area is in case of increase in scope or lease term, increase in scope, but it's a part of the existing lease, because you are not being charged standalone rental, market rental. So it's a part of the existing lease. Or there is a increase in the lease term. In these two situations, you will simply calculate the present value of lease liability at new discount rate, compare with the carrying value of lease liability. The difference will be adjusted with the right of use and lease liability. It's a simple calculation. So problem lies with where you decrease the scope of the asset or you decrease the lease term. In these two situations, you have to perform certain additional calculations. So let's have, you can say, the Excel examples. It will be very, very small impact. It will be very small impact. It will not be a huge impact. So here we have the modification. Lessee enters into 10-year lease for 2,000 square meters of office space. At the beginning of year 6, lessee and lessor agrees to amend the original lease for the remaining 5 years to include additional 3,000 square meters of office space in the same building. The additional space is made available for use by lessee at the end of the second quarter of 6th year. The increase in total consideration for the lease is commensurate with the market rate for new 3,000 square meters of office space. What it means, the additional, there is an increase in the scope, and there is a price which is being charged for the increase in the scope is also based on standalone selling price. So there will be no impact on the existing lease accounting. This 3,000 square meter will be a new lease, and that will be accounted for accordingly. Okay, let's have this example. Lessee enters into 10-year lease for 5,000 square meters of office space. The annual lease payments are 100,000 payable at the end of each year. The interest rate implicit in the lease cannot be readily determined. Lessee's incremental borrowing rate at the commencement date is 6%. At the beginning of year 7, lessee and lessor agrees to amend the original lease by extending the contractual lease term by 4 years. Here we have extension in the lease term. So you will calculate the present value of remaining lease payments at a new discount rate, compare with the carrying value of the lease liability. The difference will be adjusted with the right of use and the lease liability. There will be no additional accounting. Let's have. Okay, G. Next is at the modification date, the new discount rate is 7% per annum. At the effective date of modification, at the beginning of year 7, lessee remeasures the lease liability based on, okay, ये answer है तो इसको नीचे जरा देख लें. Here we have the values. We calculated the right of use and lease liability at the start of year 1. Here is a right of use and lease liability. Then you amortize the lease liability for 6 years. And as you see, there is a discount rate of 6%. Then there is a payment of 100,000. At the start of the 7th year, this is your carrying value of lease liability. And this is your carrying value of right of use. Now you have amended the lease and now you have added in the lease term. So here is a additional, for additional 4 years, there is a same rental, 100,000. So we calculate the present value of remaining lease payments. Here is a 100,000. As you see in the formula bar, here is 100,000, then multiplied with annuity factor. And now the discount rate is 7%. And remaining term is 8 years. 6 years completed. Total 14 years. Remaining period 8 years. You multiplied annuity factor of 8 years, add new discount rate, and you get the carrying value, which is this 5,97,130. And this is your carrying value, 3,46,511. The difference of 2,50,000 will be adjusted with the right of use and the lease liability. As there is an increase, so right of use debit, here is 251,619, here is 256,119, and right of use debit, lease liability credit, and onward, there is your 7% interest rate. Okay. Next, we have the other example. Okay. Lessee enters into 10-year lease for 5,000 square meters of office space. The annual lease payments are 100,000 payable at the end of each year. The interest rate implicit in the lease cannot be readily determined. Okay, these are the terms we have already discussed. At the beginning of 7 years, lessee and lessor agrees to amend the original lease by reducing the contractual lease by 2 years. Here we have reduced the lease term by 2 years. Previously 10 years, now 8 years. So here is a basic accounting. Initially, you book the lease liability and the right of use. Accordingly, you charge interest at 6%. And here is your, you can say, carrying value of lease liability, 3,46,511 at the start of 7th year. And here is your right of use asset, 347,636. And now there is a reduction in the lease term. For how many years? 2 years. Total remaining years? 4. So our factor will be 2 by 4. So here is right of use, 2 by 4. 347 divided by 2 करेंगे तो आ जाएगा ना भाई. Clear? But you cannot reduce lease liability proportionally because there is a present value calculation involved. Previously, your lease liability for remaining 4 years, and now it should be only for 2 years. So what you will do, you will calculate the present value of lease liability for remaining 2 years. And that is your 163,000 at old discount rate for remaining term. And here is your carrying value of lease liability At old discount rate, it should be 163, 171 because we have reduced the lease term. So there is a change of 183,000. Change in asset is 173,000. Change in lease liability is 183,000. So what we will do, we will credit the asset by 173,000, debit the lease liability by 183,000. So there is a gain in the profit or loss account. Here is the entry. नहीं पास की होगी, चले 12 कितना फर्क आता है जी, ये है जी, दोनों में निकाल ले, 95 ये है जी इधर 9522. And then step number 2, now you will calculate the lease liability of remaining rentals at new discount rate, which is 180,802. Here is my carrying value after adjustment. Now difference is 17,631, and that is increase in the lease liability. So we will credit lease liability and debit right of use. This is your second step. So if you reduce the lease liability, then there will be two components. First one is reduce proportionally your right of use and lease liability, keeping in view the present value calculation. Difference will go to profit and loss account, and then you remeasure the lease liability using new discount rate, and the difference in carrying value revised and the lease liability present value at new discount rate will be adjusted with the right of use and lease liability. Okay, ji, next we have I think you got the point. If it's okay, then we will not go in other examples. I think it's okay now. There are a lot of examples, but we have a shortage of time as well. Okay, now we are with the presentation and disclosures, and we are, I think, well familiar with the disclosures and presentation. Previously, there was a reconciliation required between the present value of lease liability and you can say present value of lease liability and the minimum lease payments. Still that is required, but previously the standard was requiring within 1 year to also specifying the time period. Now IFRS 16 says that it will be the entity's choice what time period will be more, you can say, representative of its facts and circumstances, or will be more useful to the user. So there is no specified time limit for disclosures within 1 year, 2 to 5 years, or after 5 years. Otherwise, rest of the disclosures are same. There's no major change. Okay, now we are with the accounting by the lesser. So you can say in single line, we can say there is no major change in the lesser accounting. That is same that was in IS 17. There are certain additional concepts. So we are going to discuss those additional concepts. Again, there is a classification of lease required. Previously, that was also required. And the same indicators on IFRS 16, which were previously in IS 17, there's no change. And then again, for land and building, IS 17 was also requiring that you should apply separately criteria of finance lease and operating lease on land and building. And you can also apply in combine if, let's say, the fair values or the rentals cannot be divided in land portion and building portion. The same information under IFRS 16, no change. And then similarly, there is no change in initial accounting. Again, IS 17 was requiring that there should be a dealer lesser and there should be a financial institution. The same classification is also required under IFRS 16. There's no major change. And then, as you know, if it's a manufacturing dealer lesser, you will debit lease receivable and credit your sale, and your initial direct cost will be immediately expensed out, and then you will compare your present value of lease payments with the fair value of asset, and your sale price. Sale should be, or the revenue should be at the lower of the present value of lease payments or the net investment in the lease. So वो जो same comparison है that still exists in IFRS 16. And in case of a financial institution, the IDC become part of the investment, and that is amortized, you can say, over the period. There's no change, same accounting. And then, as you know, after the initial accounting, lessor will book interest income and debit lease receivable and credit interest income. And when it receives the rental, it debit bank and credit lease receivable. Okay, a very important area, and that is basically lease receivable. Subsequent accounting is also affected by impairment and derecognition. So that should be addressed under IFRS 9, not under IFRS 16. And then we have, or I already discussed, manufacturing dealer lessor. And then here is a change in the new standard, and that is modification. Previously, there was no information given in IS 17 as far as modification by lessor is concerned. Now, modification by lessor is also discussed in IFRS 16. If it was previously classified as finance lease, or if it was classified as operating lease. If it was classified as operating lease and there is a modification, forget about whatever you've done in the past. Now, this modified lease will be a new lease, and you start accounting it as a new lease. It may be your operating lease, it may be your finance lease. It should be a new accounting now onward. And if it was a finance lease and there is a modification, then there is a question mark. If there is any addition or there is an increase in the scope of the asset, if the answer is yes, there is a standalone selling price for the additional part. If there is also yes, then it's a separate lease. But if it's if there is a different answer to the first question, adding one or more part, it means it may be reduction in lease term, it may be increase in lease term, it may be reduction in scope of asset, it may be increase in scope of asset, not at standalone selling price. All these areas will be covered under the heading no, which is answer to first question is no. The modification result in lease being classified as operating lease. You will determine whether this modification has resulted in lease being classified as an operating lease. Such a reduction in the scope or such a reduction in the lease term or other, you can say, terms and conditions of the lease, that this lease for the remainder period of the lease is not a finance lease, is basically an operating lease. If the answer is yes, then what should be the accounting treatment? Account for modification in new lease from the modification date by measuring carrying value of asset as net investment in the lease. Simply, what will be your accounting entry? Credit lease receivable, and whatever the carrying value is of lease receivable, recognize at that value the right of use, or in this case, the owned asset. Let's say you have the lease receivable carrying value 100,000, and now this lease has amended in such a way that it should be classified as an operating lease. It means you will recognize the asset under lease will be in the books of the lessor. So what should be the value of the asset under lease? The carrying value of the lease receivable. There will be no difference in the value. Simply you book the asset under lease, whatever that was, and credit the lease receivable. If the answer to first question is no, but the answer to second question is also no, that there is a change in the modification, there is a change in the lease terms and conditions, but it is not going to be an operating lease. That should be accounted for under IFRS 9. And IFRS 9 says whenever there is a modification in the terms and conditions of the receivable or financial asset, simply discount the future cash flows at the original effective discount rate. If there is any change, that will be charged to profit or loss account. Let's say you are having the value of lease receivable 100,000, and it's not being classified as an operating lease. What you will do? You will discount the remaining cash flows at the original discount rate. Let's say it comes to 90,000. So what's the difference? 10,000. You will simply credit lease receivable, debit profit or loss account. This is the accounting given under IFRS 9 for modification in the financial asset. Okay, ji. And then there is a sublease. Sublease means there is a lessor which leases the asset to a lessee, But after, let's say, getting the asset from the lessee also sublease the asset to the other, you can say, lessee. In that case, it's very important that in case of sublease, the head lessor is a lessor which is doing the accounting of lessor under IFRS 16. But the intermediate lessor, which is basically lease the asset to a sublessee, will account for the lease as a lessor as well as a lessee, and will determine whether it's a finance lease or it's an operating lease. If the intermediate lessor determine it's basically a finance lease, it will de-recognize the right of use, recognize the lease receivable, just like a manufacturer and dealer lessor, and lease liability will remain in the books of the, you can say, intermediate lessor, and it will be accounted for as it was a lessee in the original lease contract. And then it will account for the sublease as a lessor, and it will book, you can say, rental income. If it's an operating lease, it will book realization of lease receivable, will recognize interest income, and will de-recognize the right of use. And for sublessee is just like a lessee accounting. It will be, you can say, going to determine whether it's an exception accounting or it will be a lease accounting, and accordingly the sublessee will apply the accounting under IFRS 16 as an exception accounting or as a lease accounting. Okay, then we are with the sale and lease back. So the sale and lease back is a very important area, and the accounting of sale and lease back is materially changed by IFRS 16. First of all, this standard requires that you have to determine whether the sale and lease back is basically a sale and then lease back, or it's basically a financing arrangement. The answer lies with IFRS 15, and that is whether the risk and rewards, or you can say the benefits accruing from the asset, materially rest with the, you can say, buyer of the asset, now in this case the lessor, or still the major risk and rewards or the economic benefits rest with the lessee, which is basically the owner of the asset. If IFRS 15 provides the information and the criteria given under IFRS 15 give the information it's a sale, then you will go for accounting of sale and lease back. Otherwise, it will be a financing arrangement. The asset will remain in the books of the owner lessee, and whatever amount or consideration it received, that will become a loan, and it will be accounted for under IFRS 9 as a financial liability, and asset will remain in the books of the owner lessee, but it will be going to account for accounting under IS 16 or IS 40, whatever standard is applicable. But if it's a sale first and then it's a lease back, then the accounting given under IFRS 16. And that is basically, you can say, just an accounting, which is, you can say, it's just a complicated accounting, because some portion of the right of use still rests with the owner lessee, some portion of the asset or the economic benefit transfer to the buyer lessor. So certain formulas or certain, you can say, calculation detail is given under IFRS 16. So let's go through that detail. It's also a complicated one. So here is, if it's a sale under IFRS 15, you will be going to recognize right of use, because now you are basically the seller lessee. So right of use carrying value will be equal to carrying value of asset, which was under IS 16, divided by fair value of asset multiplied with present value of lease payments. It will be the value of right of use in the books of the owner lessee. What gain or loss you will calculate on the derecognition of the owned asset. Then you will determine two parts. One is the gain or loss retained, and the other is gain or loss forfeited. First, you will calculate the gain or loss forfeited, and that is basically fair value of asset minus carrying value of asset. It's a total gain. It's a total gain. Fair value of the asset less carrying value of asset divided by fair value of asset, and then multiplied with present value of lease liability. This will be the gain retained, and then you will calculate the gain forfeited. Kitna forfeit ho gaya, and that is the gain or loss forfeited will be your income. So total gain is fair value less carrying value minus the value calculated under this formula. That will be the gain or loss you are going to recognize in your books of accounts. And then very important, if your selling price is not equal to the fair value, then fair value is basically the value you can get from the market by selling the asset in the market. So gain or loss realized is always calculated by comparing the fair value and carrying value. But you may have entered with the lesser, you can say at a different price, so that will be your selling price. If selling price is more than the fair value, then the standard says it will be basically a loan given by the lesser, and that part should be accounted for under IFRS 9 as a loan. Or if the fair value is more than the selling price, it means the lessee has made advance payment or prepayment or prepaid certain rentals to the, or you can say buyer lesser. So it's a very important area. Let's have an example. थोड़ा सा complicated है तो इसकी जरा example देख लें. Here is an entity, a seller lessee sells a building to another entity, buyer lesser for cash of 2 million. Immediately before the transaction, the building is carried at 1 million. At the same time, seller lessee enters into a contract with buyer lesser for a right to use the building for 18 years. The annual payment of 1,20,000 payable at the end of each year. The terms and conditions of the transaction are such that the transfer of the building is by seller lessee satisfies the requirements for determining when a performance obligation is satisfied in IFRS 15 from contract with customers. So it's a sale. Accordingly, seller lessee and buyer lesser account for the transaction as a sale and lease back. This example ignores the initial direct cost. The fair value of the building is 1.8 million. Or how much you have sold? 2 million. So it means there is a 200,000 loan given by the buyer lesser to the seller lessee. Because of the consideration for the sale of the building is not at fair value, seller lessee and buyer lesser make adjustment to measure the sale proceeds at fair value. The amount of the excess price, 200,000, is basically a financing arrangement. The interest rate implicit in the lease is 4.5% per annum, which is readily determined by seller lessee. The present value of annual payment, 18 payments of 1,20,000 discounted at 4.5% per annum amounts to 1.4 million, in which 200,000 is basically your loan. So for lease liability, there is 1.2 million, which is basically the present value of lease liability. Here is the calculation and the accounting entries. Here is cash 2 million, and you will recognize the right of use. Here is the formula. Carrying value of asset 1 million divided by fair value of asset multiplied with present value of lease liability. M17 is present value of lease liability. And then you will de-recognize the asset building 1 million. You will book the lease liability 1.259 million, and you will recognize the loan of 200,000 and then gain on right of use. How that is calculated? Here is the total gain, 800,000, 1.8 million minus 1 million. Gain retained, you have the formula. Fair value, here is the formula. Fair value divided by, sale price, 1.M20. Total gain divided by fair value into present value of lease liability. So here is gain retained. Total gain 800,000, gain retained because you have 18 years of lease. And then this is your gain forfeited. So The gain charged to the P&L, basically the gain forfeited. You transfer to the buyer lesser. And then what accounting will be done by the buyer lesser? Here is a buyer lesser accounting. Building 2 million, cash 2 million. And then, okay, you can go through the example. It's basically sale and lease back accounting. Okay, disclosures of lesser are near about same, no change. And here is a separating lease and non-lease component. We discussed initially that it should be based on the standalone selling prices. And it should be based on the identified. If something is being paid for unidentified services or goods, that should not become part of, you can say, any accounting. That should be simply ignored. Okay, ji. Then we have IS 19. Any question you have?
Sir, if the rentals include insurance and maintenance services, and the lease is a lease of vehicle, then the
Sorry.
if the insurance and maintenance services is also part of a rental, and the lease is of a vehicle, then insurance and maintenance services is a non-lease component.
Yes, it's non-lease component. One thing left in the presentation, and that is lessee has a, you can say, practical expedient. Lessee may, you can say, go for not separating the lease and non-lease component. Lessor has to separate lease and non-lease component. So if the lessee decides that it's going to separate lease and non-lease component, then it will divide it into services and into insurance component. I think insurance should be divided, but services may not be separate.
And secondly, sir, how it can be differentiated that under sale and lease back, sale and lease back will be accounted for under IFRS 15 or under IFRS 9?
It will not be accounted for under IFRS 15. It will be accounted for either under IFRS 16 or under IFRS 9. If it is being accounted for under IFRS 9, it means you will be continuing to recognize the asset under lease as your own asset, and whatever consideration you received will be your loan under IFRS 9, and that will be booked as a financial liability and accounted for according to IFRS 9. If it's a sale and lease back, first you determine it's a sale, you apply IFRS 15 criteria. If it's a sale, then you apply IFRS 16, not IFRS 15. For only determining whether it's a sale or not, you apply IFRS 15 criteria, nothing else.
Okay. Sir, if an equipment is sale and lease back, and the title of the asset is in the name of the
Title
bank,
is not important.
so how
Keep
then
in
how
mind
we
one
can
thing.
determine that it is fall under IFRS 15?
Title is not important. Let me repeat. Title is not important. The basic definition given in framework for asset is a resource
Resource controlled by the entity.
controlled by the entity. So there is no discussion of the title.
Sir, in both the cases, control possession is with the lessee.
Now we have
Seller lessee.
this possession is basically for what period, what economic benefits. If the major economic benefit and control of the asset transferred to the buyer lesser, then it's a sale and it's a lease back. But we have to identify the requirements of lease as well under IFRS 16. Whether for that lease term, the lessee has a right to get economic benefit from an identified asset or not. That part of the useful life of the asset is basically not substantial. And that's why it's a sale L lease back. Otherwise, it's a financing arrangement.
In case of my example, just the asset was with me as a lessee, and I have sold to the bank. Asset is still there with the lessee.
What is the remaining useful life and what is the lease term?
And the remaining useful life of the asset.
Whether I have the bargain purchase option and my intention is to go for the option,
Yes.
then it's not a lease, my dear. It's a financing arrangement.
There's a very thin line between is it
It's not a
sale
thin
and
line, but it's a technical area. Okay, we have certain there is a question whether we can go for a reducing balance method or not. You can, if you are following the same method for other owned asset which belong to the same class, there's no problem. And then, okay, ji, there is a requirement we should give the Excel examples at the end. We will, inshallah, no problem. And then we have, okay, there is a requirement of Excel examples. So these are with the management, no issue.
Sir, in case of a lease of a land and lease is for 99 years, for example, how it would be accounted for? Sir?
I already said in the presentation that now it's the management call whether they want to go under IFRS 16 or under IFRS 16. IFRS 16 provide an exception to this. Okay, if it's a long-term lease, it gives an option. You can go for IFRS 16.
If I go for IFRS 16, it means then then there will be ROU and it will be amortized over the 99 years.
If you go, what I recommend, go for IFRS 16. Go for IFRS 16.
If I go for IAS 16, then it will be classified as an owned asset in this
Yes.
case.
That will be what we name it. I think that will not be under the classification of owned asset, but the accounting will be under IAS 16. That will be, I think, leasehold land. Leasehold land, not owned land. Leasehold.
Just like freehold land and leasehold
Yes.
land.
Just the accounting will be not under IFRS 16, that will be under IAS 16. But you cannot change the nomenclature because it's not your own land.
Sir, what you recommend to classify such type of leases?
If you can go for accounting every year and every year you will perform certain calculation and your job depends on this, so you should go for IFRS 16. Your management should not be in a position to say goodbye to you. You will always be complicating the things. It will be your choice. Let's have IS 19. Okay.
Thank you.
IS 19 we have. It's an old standard. There is no change. So we will be moving, you can say, quickly through this IS. These are the areas: objective and classification, then scope, then short-term employee benefits, termination benefits, other long-term employee benefits, and post-employment benefits. First of all, we have objective of this standard to prescribe accounting and disclosure for employee benefits. Okay, ji, prescribe accounting and disclosure for employee benefit. And then it's a relationship between employee and employer. And what we are going to address in this IFRS is basically employer accounting. So for employee benefits, employee renders the services to the employer, and employer, you can say, make payment or pay consideration to the employee. So we are going to account for that consideration which employer is, you can say, paying to the employee against his services. So there's a very important concept in this IFRS is matching concept or accrual concept. So we will be, you can say, identifying the period in which the employee is providing services and not the period in which actually those services are being paid. So it's a very important concept in this IFRS. Scope paragraph of this IFRS will be dealing with all employee related, you can say, payments or expenses. But if those are based on or in the shape of share-based payments, those will be dealt under IFRS 2. So if any services of the employee are being remunerated through certain share-based payment arrangements, those will be covered under IFRS 2. And again, I say it is the accounting of the employer in the books of the employer, not by any fund or you can say any benefit plan. So IS 26 will be dealing with employee benefit plan accounting or reporting by employee benefit plans. As far as the classification of employee benefit is concerned, normally we classify employee benefits into formal employee benefits, informal employee benefits, and certain statutory employee benefits. But under IS 19, we will be dividing these, you can say, 3 types of employee benefit into these 4 categories. One is short-term employee benefits, post-employment benefits, other long-term employee benefits, and then finally termination benefits. Short-term are basically those employee benefits which are going to be paid to the employee within 12 months of the reporting date or the reporting or end of the reporting period in which the employee has rendered the services. Post-employment means those employee benefits which are going to be paid to the employee after his formal retirement for those services which he provided during his employment. And then other long-term employee benefits means which are basically being paid to the employee, but not within 1 year, or you can say not after his formal employment, but you can say after 1 year, and not as a termination benefit. That's why it's normally called as residual benefits. And finally, there are termination benefits. Termination benefits are paid to the employee when his employment is basically, you can say, terminated before his formal retirement age. So those are called as termination benefits. Then we have classification of employee benefits. Employee benefits which are going to be paid within 12 months after the end of the period in which the employee rendered the services are called as short-term employee benefits. Examples are salaries, wages, social security, and then paid annual or sick leaves, and then profit sharing schemes, and then non-monetary benefits. And recognition will be simply debit expenses and credit liability if you have made the payment. If you have made the payment, then you will credit cash. Otherwise, the credit will go to liability or accrued expenses. And then short-term employee benefit continues, short-term compensated absences, and then profit sharing and bonuses. Normally, these 2 types of short-term employee benefits are paid after, you can say, after the year in which, or after the period in which the employees have provided the services, but before the, you can say, or within the 1 year from the end of the period in which the employee has provided the services. So normally you are creating a provision for these short-term compensated absences or certain profit sharing bonuses. So first of all, compensated absences can be divided into accumulating and non-accumulating. Accumulating means that you can only, you can say, get the benefit by taking certain extra leaves in the next year. And non-accumulating means that if you have not used those, you can say, leaves in the respective year, those will expire, you can say, at the end of the year. So provision is only required for accumulating. Accumulating are further divided into vested and non-vested. Vested are basically those compensated absences in which you get the cash reward, and non-vested means that you can take the extra leaves in the next year. So provision is required for both types of accumulating short-term compensated absences. And similarly, profit sharing and bonus plans, if you have a legal or constructive obligation at a reporting date to pay bonuses or a certain share of the profit to the employees, then you will create a provision at the year end for these profit sharing and bonus plans. Okay, ji, we have an example of compensated absences. As we said, these can be in the form of extra leaves, or these can be in the form of cash payment. So here is an example of extra leaves. Then you will forecast how many employees will get extra leave in the next year, and only provision is restricted to the estimated number of employees who are going to get extra leaves in the next year. And then there is a profit sharing plan. If the company has a declared profit sharing plan or certain statutory profit sharing plans like WPPF, so at the end of the year, you create a provision by debiting expenses or addition to asset and crediting your provision or payable balance. Then we are with the post-employment benefits. These are divided into two types of benefits. One is the defined contribution plans, and the other is the defined benefit plans. As far as defined contribution plans are concerned, they are just like you can say your provident funds or EOBI contributions like plans. Defined benefit are basically your pension plans or certain gratuity plans. In case of defined contribution plan, the accounting is very simple. You will simply recognize expense or in addition to an asset if the employee services are being used in construction or manufacturing of some asset, and credit your bank if you have made the payment, or credit payable, and the amount will be the contribution required under the plan. And defined contribution of plans where the employer only undertake the contribution is not, you can say, going to compensate any loss incurred by the employee benefit plan. Let's say that plan has made certain investments and there is a loss, and the loss will be of the employee, not of the employer. But in case of defined benefit plan, employer undertake a benefit. Let's say it will pay gratuity, it will pay pension. This type of plans are under these types of plans, employer undertake basically to make a payment, to make a benefit, to make a payment of a benefit. If there is certain loss in the plan, employer has undertaken the benefit, not, you can say, the contribution. That's why the accounting treatment of defined benefit plan is more technical as compared to defined contribution, because under defined contribution, there is only the contribution required under the law is going to be recognized, or by the, you can say, employer under the contract is to be required to be recognized, and you will simply book expense or addition to asset and credit payable or bank, whatever payment periodically required from the employer. But in case of defined benefit plans, you have to hire certain actuaries, or you may have to make certain cumbersome calculations to arrive at the expense to be recognized in the books of the, you can say, employer. And then these defined contribution plans or defined benefit plans can have different, you can say, types, like it may be multi-employer, it may be entity plan, it may be state plan, it may be insured benefits. So whatever the, you can, whatever name you can call it, like let's say multi-employer, it means two or more than two entities which are independent, not part of a group, have created a plan for its employees. So it's a multi-employer plan. If a plan being run by the state for the private employees, like we have EOBI, so, or we have insured benefits, certain time we basically arrange certain insurance companies, or arrange certain insurance policies for the employees, and insurance companies manage the employee benefit plans. So it's not important whatever type of plan you are using, whatever type of management you are using. It's important that what employer has undertaken. If employer has undertaken a contribution, it will be a defined contribution plan. If the employer has undertaken a benefit, it will be a defined benefit plan. But in case of multi-employer plans or state plans, or let's say insurance company plans, there may be a practical difficulty that it's a, basically, you can say, defined benefit plan, but you cannot calculate or determine the liability or the relevant asset. In that case, the standard also, you can say, give an option that as an exception, you can use that defined benefit plans as a defined contribution plan. So the accounting treatment for defined contribution plan is very easy. You will only recognizing the contribution required in a period to be as an expense or a payable or a credit to bank. But in case of defined benefit, it will be a more cumbersome calculation, and our most of the presentation on in this, you can say, area will be based on defined benefit plans. Here is a defined contribution accounting, as I already explained, there is no problem. And here is a defined benefit plan. Basically, defined benefit plan accounting is based on, you can say, projected unit credit method. What is projected unit credit method? Basically, you determine that what benefit you are going to pay at the end of the employment to the employee, and then divide that benefit to the number of years of service. So as we know, there are many variables surrounding these calculations. These are called normally actuarial assumptions, which are further divided into demographic assumptions and financial assumptions. So by calculating and by using, you can say those incorporating those assumptions, we calculate the total benefit you are going to pay at the end of the, you can say, service of the employee, and then you divide that benefit over its service. And normally the method uses straight line, but it involves a lot of present value calculations, and certain, you can say, statistical variables are being incorporated in the calculation. So let's have the discussion of this projected unit credit method, and then what accounting entries and what different aspects are covered in this area. Here are two important words being used in this presentation. One is current service cost, and the other is the present value of defined benefit liability. Basically, what is current service cost? Current service cost is the benefit which the employee has earned, during this period by rendering the services. And as this is going to be paid after so many years, so it is calculated in present value terms. So we can call it's the present value of benefit earned by an employee during a service during this year. Clear? And then what is present value? Now the employee has completed 1 year. So in this year, the present value of defined benefit liability and the current service cost is the same. But what will be the value in the next year? In the next year, there will be an opening balance of liability. Employee will earn the benefit in that year as well. And that present value of liability of the previous year has approached 1 year closer to its maturity. So there will be an unwinding as well. So when we use the word present value of liability, present value of the liability is the present value of benefit earned by an employee during his service in the current and previous years. So present value of defined benefit liability is an aggregate benefit in present value terms which the employee has earned till to date. Is called as present value of defined benefit liability. Here are the definitions given. You can also read these definitions. Okay. Then we have past service cost. What is past service cost? Past service cost is basically the change in the benefit. Change in the benefit which the employer has basically changed the terms and conditions of the employee benefit plan. It may have increased the benefit. It may have reduced the benefit. What benefit which the employee has already earned in the shape of current service cost. But now the employer has amended the plan, and because of that amendment, whether there will be increase in the benefit or there will be a reduction in the benefit, in present value terms, whatever change made by the employer in the already earned benefit of the employee or the plan is called as basically past service cost. And then gain or loss on settlement is simply when you early settle the employee benefit plan, there is a carrying value of, you can say, defined benefit liability. There is a settlement value which you are going to offer to the employee. The difference will go to profit or loss account, and that will be called as settlement gain or loss. What is plan asset? Basically, the defined contribution plans are always funded plans, because employer and sometimes the employee is contributing in the employee benefit plan. In case of defined benefit plan, they may be funded, they may be unfunded. Funded means the employer and the employees are making contribution in the plan as well. But that contribution basically doesn't avoid the undertaking which the employer has, you can say, made in the case of defined benefit plan. Is basically, you can say, a resource is being developed that whenever an employee retires, the payment should not be made from the employer's bank account, or employer's resources should not be required to make the payment, but a separate fund should have a sufficient resources. Whenever an employee retires, payment should be made from that fund. So defined benefit plan, if funded, then there is a concept of plan asset, because in case of defined benefit plans, employer doesn't recognize the contribution to the defined benefit plan as an expense. It's an asset, because that will be used to make payment against the defined benefit liability, which it has already recognized in the form of current service cost, unwinding of certain, you can say, opening balance of defined benefit liability, and in case of past service cost. So there is a gross balance of defined benefit liability appearing in the employer's balance sheet, and there is also a contribution which is being made by the employer and the employee in a fund that will be called as a plan asset, which will be used to make payment to the you can say employees in case of an employee retires. So plan asset is basically an aggregate balance of contribution or return on the, you can say, fund or the plan assets, which is being available to the employees who retire from the employment. It may be in the form of owned management. It can be being managed by the employer, and that will be, you can say, under the management of the employer. That will be, you can say, normally in the form of plan assets being managed by the employer, and that is normally a separate fund, a separate bank account, a separate investments. And sometimes you basically call certain insurance companies and you give these balances to the insurance companies. If you make payment to the insurance companies, then there is another question, whether the ultimate responsibility to make employee benefit, to pay employee benefit has been transferred to the insurance company, or the ultimate responsibility rests with the employer. If the ultimate responsibility rests with the employer, then such types of insurance policies are called as qualifying insurance policies. And if after, you can say, engaging with the insurance companies, the ultimate responsibility to pay employee benefit rests with the insurance company, then this type of contribution will become defined contribution plan, and that will not be a defined benefit plan. And so it's very important then when you engage the insurance companies, you have to identify whether the ultimate responsibility to pay employee benefit transfer to the insurance company, or that remains with the employer. If that remains with the employer, then these insurance policies will be your plan assets and will be called as qualifying insurance policies. But if the employer's responsibility is only restricted to the contribution, and the ultimate responsibility to pay employee benefit has been transferred to the insurance companies, then it will become a defined contribution plan. It will no more be a defined benefit plan. So defined benefit plan, when we talk about defined benefit plans, so we also concentrate two more concepts, and one is plan asset. When you talk about plan asset, what it conveys? It means it's only available to pay employee benefits. It's not available to pay to the creditors of the employer. This is very important. That's why IS 19 allow offsetting between defined benefit liability and plan asset. That you should offset plan asset with the defined benefit liability and recognize a net amount in the balance sheet, because those plan assets are only available to pay employee benefits. There are certain, you can say, exceptions, that if there is extra payment made by the employer, or there are certain, you can say, arrangements by the employer with the defined benefit plan, that if there are certain extra earnings, they can get a certain amount back from the employee benefit plan. Otherwise, plan assets are only available to pay employee benefits. Those are not available to pay the creditors of the employer. And that's why whenever there is surplus in the balance sheet, you apply the concept of ceiling, that whether this surplus is available to the creditors of the employer. If not available, you de-recognize a plan asset, and you only recognize plan assets up to that extent to which the surplus is available to the creditors of the employer. So it's very important concept plan asset means those assets, whether managed by the employer itself, whether managed by the defined benefit plan, whether it's an insurance policy, which is being classified as qualifying insurance policy. The important thing is it should be available to pay employee benefits. There is an IFRS 14 which provide information when there are certain mandatory contribution required from the employer, then how much surplus should be recognized in the financial statements of the employer, but it's a separate chapter. So we only restrict our discussion to the IS 19, and IS 19 says the plan asset means only that asset which is available to pay employee benefits and not available to the creditors of the employer, except certain situations in which employer can get the refund under the, you can say, certain arrangements which have already been agreed with the employee benefit plan, or it may have, the employer may have made certain payments on behalf of the employee benefit plan. Only then it can get a refund from the plan assets. Otherwise, there's no situation in which the employer can get back, or it can use the plan assets to pay its creditors. Okay, ji. Next we have net interest cost. As I already discussed, our opening liability is basically when 1 year pass, it becomes 1 year closer to its maturity, then it's unwinding. And this IFRS requires that interest cost and return on plan asset should be recognized at one rate, and that rate should be the you can say government securities rate, which are, you can say, being available in your country, or a high quality corporate bond rate. It is not your market rate, it's not your own rate, it's based on either the government securities or the high quality corporate bonds rate. High quality corporate bond rate is, you can say, having preference over the government bonds or government securities. So for interest cost, you will use the interest rate, which is based on high quality corporate bonds or government securities, whichever is available. And then past service cost, we have already discussed, and then we have settlement gain and losses, we have already discussed. So ठीक है, मास पढ़ लेते कर लेंगे ब्रेक यहाँ, ठीक है ना, मैंने बता रहा, तो बता देंगे। Okay, ji, let's start. This is basically the offsetting which we were talking about. That present value of liability will be offset with the fair value of plan asset, and the difference will be deficit or surplus. If it's a deficit, then there will be no issue. But if it's a surplus, then it will be a problem, because this surplus may not be available to the creditors of the employer. So you have to apply asset ceiling on it. Okay, let's have an Excel example first to understand the projected unit credit method. And then we will go through these different slides. Okay, ji, basically, what is projected unit credit method? It's a IFRS example. So a lump sum benefit is payable on termination, means retirement of service, and equal to 1% of final salary for each year of service. The salary in year 1 is 10,000 and is assumed to increase 7% each year. The discount rate used is 10% per annum. So IS 19 basically requires that defined benefit plan should be accounted for under projected unit credit method. So what is projected unit credit method? This is year 1 salary. This is year 2 increased with 7% increment, year 3, year 4, year 5, and it will be the final salary, 13,108, and 1% of this is 131. So employee will be given 131 for each year of his service. It's 1. And then if you multiply this 1% of final salary with the total number of years of service, which is 5 years, you come up with the total value of 655.40. And then if you divide it by 5, it will be your 1 unit. So as the defined benefit plan is based on the final salary, the benefit employee going to earn in, let's say, in gratuity or in pension is not your current salary. That is basically the salary. जैसे pension calculate होती है तो कैसे होती है? Final salary multiplied with a factor, let's say 40%, 50%, and then you given till the death of the, let's say, employee. So it's calculated on the final drawn salary. Gratuity, last drawn salary multiplied with the number of years of service. So gratuity is not based on current salary, it's based on final salary. So what is this method? Projected unit credit method. First you project what will be the total benefit the employee will be eligible to get at the end of his employment. And then you divide that benefit over his expected employment and you create a unit. Unit credit. At the end of every year of employment, you credit 1 unit to his account, and that is called projected unit credit method. But problem is that this 131 which the employee has earned in current year is basically going to pay him or going to be paid at the end of year 5th. So this is your current service cost, is the present value of benefit earned in current year based on final salary. So it's your present value. This is called current service cost. This will be your current service cost. This will be your closing balance defined benefit liability. Then it will become your opening balance. In this year, you have also earned 131, but this 131 is requiring 3 years to pay. So it's 98.48. Then this opening balance has approached 1 year closer to its maturity. it's your unwinding, you can say interest cost. So it's 196.96 as the closing balance of liability and so on. And finally, you can check that it's 665.11. So this method is basically called as projected unit credit method. And then if you want to identify what is past service cost, so let's say I just the closing balance is 196.96. And if the employer change, let's say the already earned benefit, that change in present value terms is called as past service cost. Let's say this employer has doubled the benefit. If the employer has doubled the benefit, let's say it's 2% of the salary. This is your past service cost. Clear? Okay. Then again, we have the presentation. Now you can go through these steps one by one. First, determine the deficit or surplus, ultimate cost of benefit, discount it to determine the present value of benefit obligation, deduct fair value of plan asset, determine amount and statement of financial position, determine amount and profit or loss account, determine remeasurement to other comprehensive income. These are the different steps involved in the defined calculation or accounting of defined benefit plan. Let's have step number 1. Okay, in case of defined benefit liability, there will be many variables. Later on, we will see those variables as well. Then apply actuarial method to incorporate those variables. Attribute benefits to the period. आपने देखा हमने कैसे benefit apply कर दिया है. Make actuarial assumptions. So this is basically the step number 1. This is your actuarial valuation method, as we saw in the example. 5 years divided over, you can say, projected final salary, divide that salary over the years. So here is unit 1 and so on. And then attributing benefit to the period. As the employee, you can say, complete his service, every year he get 1 unit, which is called as current service cost, and so on. This example is also in the presentation as well. And then actuarial assumptions, on which, let's say we are saying 7% increment, we are saying 10% discount rate, we are saying 5-year employment plan, employment span. All these are our assumptions basically, and that 655 benefit is basically based on those assumptions. These assumptions are called demographic assumptions and financial assumptions. Demographic assumptions, we have mortality rates, rate of employment turnover, proportion of plan members eligible for benefit, claim rates under medical plans if there is a medical plan. Then financial assumptions, we have discount rate, future salary, benefit levels, future medical, taxes payable by the plan. All these are your basically financial assumptions. And incorporating these assumptions, we will basically come up with the expense to be recognized. And later on, if you are going to recognize certain return on plan assets, so these basically assumptions play a very material role in performing all these calculations. What accounting entries normally we make, basically, normally we confuse with what accounting entry is required. If there is a current service cost, accounting entry will be current service cost, defined benefit liability credit, past service cost if there is increase in the benefit, defined benefit obligation credit, employer or the employee made contribution in the plan asset debit and bank credit, and then net interest cost, it's unwinding. It's also important that IS requires that return on plan asset and unwinding on defined benefit liability should be offset with each other, and net amount should be recognized in the profit or loss account. So that's why we use the word net interest cost debit, defined benefit liability credit. If you have any return on plan asset, as I already said, we will use the same discount, we will use the same interest rate for discounting of defined benefit liability and return on plan asset. So plan asset But there's a difference in recognizing the return on plan assets. There is an actual return, there is a expected return. This standard require that you will recognize expected return, and that at the end of the year you will compare your expected return and actual return. The difference will be your remeasurement adjustments, which will be recognized in other comprehensive income. So it's very important that return on plan asset is booked at an expected or recognized at an expected amount, which is basically the interest rate which are you using for discounting your present value, discounting your defined benefit liability. And then if there is a remeasurement, as I already said, there's a difference between expected return and actual return. If the difference is gain, then this will be your accounting entry. If this difference is a loss, then there will be a reverse entry. And similarly, remeasurement loss, debit and defined benefit liability account credit. It will be when there are certain experience adjustments or changes in actuarial assumptions, then there will be some actuarial gain or loss. In that case, you will book the entry remeasurement loss, debit and defined benefit liability credit. And then if you make payment to the employees, defined benefit liability debit and plan asset credit. So these are the normal accounting entries which we incorporate under IS 19. Actuarial gains and losses are recognized in other comprehensive income. They may be because of experience adjustments or effect of changes in actuarial assumptions. What is experience adjustment? As we, let's say, estimated that this employee will remain with us for 5 years. Let's say it basically not remain with the entity for 5 years. It, let's say, retires, or you can say left the entity after 3 years. Our calculations are based on final salary of 5th year. So the payment we are going to make will be different from our carrying value of liability. That will be our experience adjustment. Sometimes our actuary change the assumptions. Assumption, in the previous example, the assumptions were, let's say the employee will remain for 5 years, the discount rate is 10%, the annual increment is 7%. All these are our assumptions. And let's say at the end of first year, we get the report from the actuary. He basically bases calculation on 5 years. Let's say on the end of second or third year, we get another report. He said, now let's say employment time will not be 5 years, it will be, let's say, on average 6 years or 7 years. So our, let's say, end of employment benefit will change. Or you can say the benefit we are going to make payment is different from the value which the actuary will provide, let's say, in the new actuarial report. So that will be called as change in the actuarial assumptions. Let's say there is a change in the discount rate, there is a change in the annual increment rate, the actuary in the second report change different variables. So there will be actuarial adjustments. So whatever the effect of actuarial adjustments or experience adjustments, that is not recognized in profit or loss account, that is recognized in other comprehensive income. Okay, we have discussed past service cost. And then we have a plan asset. We have discussed plan asset, what are qualifying insurance policies, what are owned, you can say, managed plans. We have already discussed it. Okay, here is the concept of ceiling. If there is a deficit, you compare your defined benefit liability, present value of defined benefit liability with your fair value of plan asset. If there is a deficit, means present value of liability is higher than the fair value of asset. It's a deficit. It will be part of your non-current liabilities in the balance sheet. But let's say it's a surplus. Then there is a question whether this surplus is also available to the creditors of the employer, which normally not available. So in that case, what we will do, we will apply an asset ceiling on the surplus balance. What actual balance is available to my creditors, and we will reduce our balance of surplus to that extent which is actually available to my creditors. So you will de-recognize some part of the plan asset, and that will go to other comprehensive income. But it's very important, it's not an expired asset or lost asset. it's basically not available to my creditors. So at the end of the year, I will de-recognize that part which is not available to my creditors. But at the start of the next year, I will reverse that entry again because that is not available to my creditors. That is available to pay employee benefits. So it's very important. Ceiling at the end of the year applied, you de-recognize some part of the asset which is not available to creditors or which is not available in the form of a refund or a reduction in future contribution. And at the start of the next year, you reverse your entry because that is not available to my creditors, but that is available to pay employee benefit. So it's very important. This concept is called as asset ceiling. And then normally what amounts are recognized in profit or loss account are current service cost, past service cost, any gain or loss on settlement, and then net interest is also recognized in profit and loss account. Items recognized in other comprehensive income are actuarial gains and losses. The return on plan asset less amount included in net interest means the difference between expected and actual return, and then changes due to asset ceiling. These three items are recognized in other comprehensive income in the name of remeasurements. Okay, let's have an example. Quickly, we will go through this example. Just to have an idea what will be the presentation, what will be the you can say different items to be recognized in P&L or other comprehensive income. The following information is given about a funded benefit plan. To keep interest computation simple, all transactions are assumed to occur at the year end. The present value of the obligation and the fair value plan asset were both 1,000 at start of the year, 1st January 20x1. Then आपको 3 years का data given है, discount rate, current service cost, benefit paid, contribution paid, then present value of obligation, fair value of plan asset. In 20x2, the plan was amended to provide additional benefit with effect from 1st January 20x2, means past service cost. The present value as at 1st January 20x2 was 80 for additional benefit for employees. On 1st January 20x2, the pension benefit paid 200 employees transferred to another plan against total liability of 230. So what will be your basic calculations? First of all, this will be your movement of liability. If you see, there is an opening balance of 1,000, current service cost is added with the liability, then benefit interest cost is calculated on the opening balance, is recognized, net interest cost debit, defined benefit liability credit. Then you pay the benefit, means there is a reduction in the liability, defined benefit liability debit, plan asset credit, and then there is a closing balance of the liability given 1141, but this balance is not equal to 1141. The difference is because of, you can say, certain experience adjustments or certain adjustments because of change in actuarial, you can say, estimates. So this will be your remeasurement gain or loss. It's a loss in this case. Similarly, you have brought forward balance of asset. There is a contribution added in the asset. Then there is a return on expected return at the same interest rate. Then you paid the benefit, and then you have the closing fair value of the plan asset. Again, this balance is not equal to this closing balance of fair value, means there is a difference between expected return and actual return. That will be your remeasurement gain or loss. So here is your remeasurement. There is a, you can say, gain on plan asset. There is a loss on defined benefit liability. Offset with each other, there is a net loss. So here is your presentation of profit or loss account. You have current service cost in the P&L. You have remeasurement loss in the other comprehensive income. Then there is a total effect on the P&L. Then you have opening balance of, this is your opening balance. This is your closing balance of liability. This is your closing balance of asset. And this is net deficit. There's no need to apply asset ceiling. This will be your balance. This will be your liability in the balance sheet. And so on. In the next year, you will prepare the same workings. This is also your disclosure in the financial statements as well. Analysis of investment on plan asset. you may have made certain investments in government securities, certain stock exchange securities, certain you can say deposit accounts or others that will be reported over here. Then you use the discount rate, and then you use the average remaining working lives of the employees as an actuarial assumption. These are normally the disclosures in the financial statements. Similarly, in the second year, you have opening balance of liability. Here is a current service cost. Here is an interest. Here is a benefit paid. Here is a past service cost. Again, your closing balance is not reconciled with your carrying value of liability. Again, your difference is your remeasurement gain or loss. Similarly, with the asset and so on. Okay, any problem? Okay, next we have other long-term employee benefits. Other long-term employee benefits are accounted for in the same way in which post-employment benefit plans are accounted for. If it's a other long-term employee benefit plan in the nature of defined contribution plan, the contribution required you recognize as an expense or an addition to asset. If other long-term employee benefit plan is in the form of defined benefit, you apply the same accounting we discussed in the defined benefit plan. The only difference is there's no concept of remeasurements. There's no concept of remeasurements to be recognized in other comprehensive income. If there is a remeasurement, that will be charged to P&L. There's no concept of asset ceiling. If there is an asset, it's an asset. If it's a deficit, it's a deficit. The normal examples can be long-term paid absences, like sabbatical leaves, jubilee leaves. But sometimes you can say, provide certain other long-term benefits in the form of defined benefit. You arrange certain, you can say, travels and tours for the employees, and you bear the cost. Or let's say there are certain medical expenses in the form of, let's say, paternity and maternity leaves. Then those will be your defined benefit plans. But please remember, there's only difference from post-employment plan is there's no concept of other comprehensive income. There's nothing to be charged in other comprehensive income. There's no ceiling concept in other long-term employee benefit plans. Otherwise, rest of the things are the same. And then we have termination benefits, forceful termination or voluntary. In accounting, there's no difference. And that is the additional benefit you are going to make to your employee other than the post-employment benefit will be recognized as an expense, as there is no benefit now available from the employee or his services. So you will recognize the expense. And in case of voluntary, or you can say voluntary type of schemes, there is, you can say, some expected number of employees going to opt the, you can say, these voluntary redundancy scheme. So you will apply certain expected values or expected or expected or certain, you can say, statistical calculations. Otherwise, if there is determined or confirmed number of employees who are going to leave, then you will simply recognize their termination benefit as an expense, and there is no need to calculate any expected number or expected calculations. Then this is your termination benefits. I think it's enough. Now we are with IAS 23, but in IAS 23, I'm only going to identify those or one area which is normally ignored in our calculation. The rest of the things are same, which are basically, you can say, you have read many times in many, you can say, ICAP papers as well. So I may not be giving much time to those areas. So let's have scope paragraph, scope and objective. IAS 23 provide guidelines for accounting treatment. Okay, IAS 23 is something happening. IS 23 provide guidelines for accounting treatment of borrowing cost. Borrowing costs include interest on borrowing cost. Basically, what is borrowing cost? Borrowing costs include all ancillary costs incurred in connection with the borrowing of funds is called as borrowing cost. That may be formed in the form of discount on issuance of any debt securities, that may be in the form of premium, that may be in the form of coupon rate, that may be in the form of certain issuance cost. All these are ancillary costs incurred with the connection of borrowing will be called as borrowing cost. Okay, what's important is that okay, let's forget about objective and scope. मेरा ख्याल है जो जो सुन रहे हैं वो हमसे ज्यादा जल्दी में Basically, we will be concentrating on this part, which is basically foreign currency exchange differences. In what circumstances an exchange loss on foreign currency borrowing can become borrowing cost. Rest of the standard, I think all the people know it, so I will not be going in detail, but we'll be completing it rapidly. नहीं पता तो चले ना जी वो किधर है
Sir, एक question था. Sir, accumulated absences. If amount is immaterial and we made a provision under IAS 37, when this amount become immaterial and we measure the provision as per IAS 19, whether it will be a change in accounting estimate or change in accounting policy. Accumulated absences are measured under IAS 37 because it was immaterial amount, and we are measuring. No, sir, we are measuring on termination basis, like because amount is immaterial and we account for it on actual basis that will be paid in future. Because provision is being recognized. Small and medium size दोनों sides में.
नहीं IFRS कंपनी में अलग से है
No sir, उसमें भी termination basis allowed
है
allowed termination basis पे
भाई कर लिया ठीक बस जरा यार खत्म कर ले जल्दी से हाँ okay जी then we have scope paragraph basically when certain assets are measured under fair value model in those assets you cannot add borrowing costs. So, even that asset is a qualifying asset, but if it's being measured under fair value model, then you cannot add borrowing costs. Like you have biological assets, maybe a qualifying asset because it's a, let's say, immature asset and take time to mature, but it will not be accounted for, or borrowing cost will not be added in biological asset. Similarly, large scale repetitive production like inventories will not be considered as qualifying asset. And then we have what is borrowing cost. Borrowing costs simply all ancillary costs incurred in connection with borrowing of funds will be called as borrowing cost. But any return on equity is not borrowing cost. Qualifying asset, that asset which takes material time, materiality concept will depend on the entity's estimate. There may be 6 months material, there may be a materiality of 1 year, but it will depend on the entity, not on standard has not defined any period as a material period. So it will be the entity who will decide what is material time. If an asset takes material time to get ready for its intended use or sale, means if there is an inventory which takes material time to mature, will also be a qualifying asset. Okay, recognition. If borrowing costs incurred other than a qualifying asset will be charged to profit or loss account. Otherwise, it will become part of the cost of the asset. Then we have measurement. Then there are two types of loans. One is specific loan and the other is a general loan. In specific loan, the borrowing cost is basically the actual borrowing cost incurred. In case of general loans, it depends what amount you actually invested in the asset. So specific loan, actual borrowing cost incurred. And in case of general loan, it is basically the borrowing cost basically calculated on the amount which is invested in the asset. So if you have more than one general loans, then you will calculate a weighted average rate adjusted with the values and the time period if involved. But the difference is specific actual borrowing cost incurred. And if you have made certain investments from that specific fund and you have earned some income as well, the borrowing cost will be your net after deducting the interest income. But if it's a general loan, then the borrowing cost which can be eligible under IS 23 will be based on the amount which is actually invested in the asset. Then there are three conditions which are normally required to be satisfied before recognizing borrowing cost into the cost of the asset. Borrowing cost is being incurred, then construction of qualifying asset or necessary activities to complete the asset have been initiated. Then expenditure being on the asset is being incurred. If these three conditions are satisfied, only then you can add borrowing cost in the cost of the qualifying asset. And then if because of certain unforeseen reasons which are not normal, the construction of a qualifying asset is suspended, the borrowing cost is also suspended. When the asset becomes ready for its intended use, the borrowing cost ceases to be added into the cost of the asset. If the asset is being completed in parts, and each part, if completed, is ready for its intended use, the borrowing cost for that part ceases, but borrowing costs to be incurred on other parts which are yet to complete will continue to be added in the cost of the asset. Then this is basically the issue which I want to discuss. Basically, sometime we borrow in foreign currency, and like Pakistan, like countries, we incur certain huge exchange losses. So whether those exchange losses can become part of the borrowing cost and can be added in the qualifying asset, the answer is yes. This standard provide basically two methods for calculation of that part of exchange loss, which can be added in the cost of the asset. One is based on the actual change in exchange rates, and the other is based on the change in projected exchange rates. So here is an example, or model one, model one, actual borrowing, actual exchange loss incurred. What part of that actual exchange loss incurred can become part of the cost of a qualifying asset. Example, सही देख लेते हैं. Let's say on 1st October 2014, inception of USD bond of 100 million, spot exchange rate 6.1394, US bond interest rate 7%. Assume similar PKR borrowing rate with an interest rate of 9%. Estimated interest amount for PKR 100 million. Yani aap basically what you will do, you will assume that although I have borrowed funds in foreign currency, but let's say if I have borrowed in my functional currency, what should have been my borrowing cost? Got the point? I need, let's say, 100 million PKR. Instead of getting 100 million PKR from a local bank, I borrowed from a foreign bank. And then I will calculate what borrowing cost I have to pay if I have borrowed in PKR. That will be an amount. Then you will calculate the actual borrowing cost incurred on a foreign currency loan. And then you will calculate exchange loss on the foreign currency loan. The difference between borrowing cost has been incurred if I have borrowed in local currency and the actual borrowing cost incurred on a foreign loan, the difference in these two figures will be compared with the exchange loss. If the exchange loss is more than this amount, the difference can be added in the cost of a qualifying asset. If your exchange loss is less than this difference, then that exchange loss or whole amount can be added in the cost of a qualifying asset. So it's basically a very important area. Most of our basically practitioners ignore this area and expense out the whole of the exchange losses. But it's a very important area. You can add this exchange loss into borrowing cost, and then borrowing cost of qualifying asset can be added in the cost of the asset. The second method is basically using the projected, you can say, exchange rates and incorporating that. So here is a formula. Fn is equal to S into 1 plus I domestic raised to power n divided by 1 plus I foreign. It's a very complicated one. So you can you can follow this. So these are the two methods, not given by the standard, but given by, you can say, some big four firms as an interpretation to be used for capitalization of exchange losses. So it's all about this IS 23. Please ये जरा second वाली share कर दो आगे. नहीं वो एक और फाइल है.
Whether it can be capitalized if it is an integral part of the qualifying asset.
Okay, ji, now we are with our last topic, which is earning per share. First of all, objective of this IFRS. IS 33 basically deals with calculation and presentation of earning per share. And then on what type of entities this standard is applicable, those which are listed or in the process of listing. Then if anyone voluntarily can use, so it can. What is dilution or anti-dilution? Sometime the entity may have entered into certain contract to issue shares, and then those contract to issue shares may be dilutive in nature or anti-dilutive in nature, as EPS is calculated as basic EPS as well as dilutive EPS. Basic EPS is based on earnings and actual number of shares and issuance which have the claim over dividend. The dilutive EPS is based on those share earnings as well as those shares which are issued and those which are potentially issuable, but they are potentially issuable only considered if they are dilutive in nature. If a potentially issuable share, that will be divided into two categories, whether it's a dilutive potentially issuable share or it's a anti-dilutive potentially issuable share. If it's a dilutive potentially issuable share, it will become part of the dilutive earning per share. If it's a anti-dilutive, then it will be ignored in the calculation of dilutive EPS. What is dilution? Dilution means if it is assumed that, let's say, this potentially issuable shares have been issued, then if this potentially issuable share have been issued, if my earning has dropped, it will be called dilutive, and if my earning have increased, then it will be anti-dilutive. Basically, these potentially issuable shares are of two types: those which have effect on earning as well, and those which have no effect on earning. Like, let's say if you have some written call options or written purchased options, written call options and written put options, then there will be no effect on earning because you are not paying any return on those options. But if it's a convertible loan or it's a convertible preference share, then you are paying also some dividend to these potentially issuable shares. So when you calculate dilution, then you assume, let's say this potentially issuable shares have been issued. Then if it has been issued, then there have been no interest to be paid, no preference dividend to be paid. So then there will be an effect on earning as well as on the number of shares. So if the effect on earning is proportionally more than the effect on number of shares, because earning is your numerator and your number of shares is your denominator. So if the proportionate share of earning is more than the proportionate effect on your denominator, then you will say it's basically anti-dilutive. Otherwise, it will be dilutive. So potentially issuable shares are only considered for calculation of dilutive earning per share if they are dilutive in nature. If they are anti-dilutive, like let's say we have purchased call options, purchased put option. Purchased call option means the entity has the right to exercise. हर entity कब exercise करेगी right? When it's beneficial to the entity. And when it is beneficial to the entity, it's anti-dilutive. Or some convertible preference shares or convertible, you can say loans, have less proportionate effect on earning as compared to, more proportionate effect on earning as compared to their denominator, then it will also be anti-dilutive. In that case, those will be ignored in the calculation of earning per share. Then we have contingent share agreements. Like under IFRS 3, we acquire certain subsidiary companies and we enter into certain contingent share agreement with the old shareholders of the subsidiary company. So whether those contingently issuable shares will become part of the basic earning per share or dilutive earning per share, this standard requires that contingently issuable shares cannot become part of the basic EPS or dilutive EPS unless the condition on which those contingently issuable shares have been, the contingently issuable shares based has actually satisfied. After the satisfaction of that contingency on which the issuance of those shares is based has satisfied, only then it can become part of the basic EPS or dilutive EPS. Yes, it will be in a different manner. It will become part of the basic EPS in a different manner and part of the dilutive EPS in a different manner. But contingently issuable shares cannot become part of basic or dilutive unless the contingency is resolved. Okay, then we have definitions of warrants and options I already discussed. What is basic earning per share? Basic earning per share is basically earnings attributable to ordinary shareholders. This is very important, attributable to ordinary shareholders. Or attributable to ordinary shareholders means that earning which is available to ordinary shareholders. That should be after interest, after tax, any preference dividend, and preference shares are further divided into cumulative or non-cumulative. In case of cumulative, although let's say dividend in this year is not going to be paid because there is insufficient profit, but while calculating basic EPS, you will deduct that dividend available to available to preference shareholders, which are cumulative in nature. In case of non-cumulative, the dividend will only be deducted to arrive at this figure if that has been declared during current year. So it's very important that what profit is actually available to the ordinary shareholders. So it will be earnings divided by weighted average number of shares. If there have been certain shares issued during the year, then it's very important that whether those shares are issued at market value or other than market value. If those are issued at market value, then it will be a simple weighted average. Otherwise, if these are bonus shares or you can say right shares or certain you can say consolidation of shares or certain you can say split of shares, in that case, the new shares are to be issued or change in the number of shares is not based on the market value, then these types of transactions will not only affect the current year's weighted average number of shares, but also affect the comparative year weighted average number of shares. So it's very important while calculating the weighted average number of shares, you should determine whether the shares issued during the year are at market value or at other than market value. So formula is very simple. Earnings attributable to ordinary shareholders divided by weighted average number of shares. Sometime in an entity, there may be certain continuing operations or there may be certain discontinuing operations. This IFRS requires that for continuing operations and for discontinuing operations, you should calculate separate EPS, both basic and dilutive. Although this standard allows that you can present net EPS on the face of the income statement, you can give a disclosure in the notes to the financial statement, or otherwise you can present on the face of the income statement from continuing and discontinuing. So it's very important that while calculating EPS, you should determine that whether certain operations are discontinuing during the year or discontinued during the year or not. If all the operations are continuing, then there's no problem. But if there are a certain continuing and discontinuing operation, then you will calculate your earning per share, both for continuing and discontinuing separately. Let's have a quick example. Okay, let's have this example. Income from ordinary activities, loss on discontinuing operation, net income 6% cumulative, participatory preference share capital. And then we have common shares, ordinary shares at the start of the year, then shares issued for cash during the year at market value, shares issued for cash at market value, second, and then there are certain shares which have been purchased back during the year. And then we have EPS. So first of all, what is the earning which is available to the ordinary shareholders? So this was your profit, 95,000. You will deduct preference dividend and they write over a profit as well because they are participatory in nature. This is the profit available to ordinary shareholders. And in this, basically, there is a loss from discontinuing operations as well. So here is a profit available to shareholders, ordinary shareholders from continuing operations. This will be your discontinuing operation, and this will be your net profit available to ordinary shareholders. Then you will calculate number of shares. Here is a weighted average number of shares. Okay. So at the start, basically, there is a trick in the example. Closing number of shares were given. Sorry, no, opening given. 78,000. Then you have second issue 98,000. Then third issue. Then you purchase back all that you can say transactions basically occurred after 3 months. So every aggregate number of shares outstanding for 3 months. So here is your weighted average number of shares, and then this is your weighted average number of shares, and here is your this. This is your basic EPS from continuing, this is discontinuing, and this is net. Okay. Then, as I already said, it's very important that shares issued during the year are at market value or at other than market value. So if no change, simply closing number of shares will be your denominator. Otherwise, weighted average number of shares will be your denominator. But if the shares are or shares have changed and the change is other than the market value, the shares issued or purchased back or other than market value, then it will be having effect on comparative year as well. So examples can be bonus issue, consolidation oblique split of shares, and then right shares we have. If it's a bonus issue, then basically you will also restate your comparative year. You will calculate basically a factor, which will be your total number of shares after bonus issue divided by total number of shares before bonus issue. For the current year, you will multiply the number of shares before bonus issue with the factor, and then add simply the weighted average number of shares after bonus issue. For the comparative year, you can change the weighted average number of years with the same factor and then recalculate the basic earning per share. So basically, this bonus issue has an effect on the comparative year as well. And what standard use the wording that assume bonus issue has always been issuance. It's not basically during the current year, has always been issuance. It means it will be included in the weighted average number of shares for the full year. For the current year, it will also assume to be issued in the comparative year as well for the whole of the year. And IS 10 also provide a slight information that if bonus issue is after the year end, that will be an adjusting event for the calculation of EPS. So it's very important that if a final bonus issue, which is normally after the year end, that will also change your basic EPS of the current year and comparative year. I think should not go through the example, it's simple. Okay, then we have right shares, same scenario. In case of right shares, this standard requires that as this is also not in market value, this will also restate your comparative year. And it will also be assumed that it has been not issued during the current year, but it has always been issuance. So you have to restate your comparative year weighted average number of shares. The only difference is in case of right shares, we also receive some consideration as well. So here the fraction or the factor is slightly different. It's basically market value just before the exercise of right divided by theoretical X right price. So in case of bonus share, the factor was simple. Total number of shares after bonus issue divided by total number of shares before bonus issue. In case of right shares or right issue, the factor will be market value just before the exercise of right. It may be called come right price divided by theoretical X right price. Theoretical X right price is basically the market value of shares before right issue plus exercise price of right shares divided by total number of shares after right issue. That will be called as theoretical X right price. The rest of the things are same. It will be multiplied by the weighted average number of shares before right issue and then simply you will add weighted average number of shares after right issue with the before right issue weighted average number of shares, and you will multiply with the weighted average number of shares of the last year with the fraction market value divided by theoretical exercise price. You change the weighted average number of shares and you recalculate the basic EPS and as well as dilutive EPS. It's very important that shares issued other than market value restate the comparative year basic EPS as well as dilutive EPS. Now we have dilutive earning per share. Basically, in case of dilutive earning per share, you calculate incremental EPS. Incremental EPS means, first of all, the question arises whether the potentially issuable shares are dilutive in nature or anti-dilutive in nature. And the standard requires the most dilutive earning per share should be reported. It means if there are more than one potentially issuable share, then you will go for most dilutive. A potentially issuable share may be dilutive in its individual capacity, but in aggregate it may be anti-dilutive because it's not producing most dilutive earning per share. So it's very important that you calculate the most dilutive earning per share. Individually, a potentially issuable share may be dilutive, but in aggregate it may be anti-dilutive. That's why there is a concept of incremental EPS. Incremental EPS means effect on earning divided by effect on number of shares. This will be your incremental EPS. And then if there are more than one potentially issuable shares, then there will be a ranking from most dilutive to the least dilutive. And then you start adding one after the other. And which EPS is most dilutive? Because after some time, after let's say adding 2 or 3 potentially issuable shares, it may, you can say again, rising upward. So the most dilutive will be the most dilutive will be the earning per share, which is basically after, which is you can say less than that dilutive EPS which has start rising. So it's very important you calculate the most dilutive. So that's why in calculation of dilutive earning per share, there are 2, 3, 4 steps. First of all, you calculate the control number. What is control number? Dilution cannot be determined unless you have some number from where you want to calculate the dilution. You want from this, there should be a reduction. That control number is basically basic earning per share from continuing operations. That is your control number. And then you calculate incremental EPS for each potentially issuable share. And then you make a ranking from most dilutive to the least dilutive. The lesser the incremental EPS, the more dilutive is that. And then you start adding one after the other with the control number. Till the time the EPS declines. And when it starts rising, you stop, and that is basically the remainder or the rest of the potentially issuable shares are anti-dilutive. This is the process in which you get the most dilutive earning per share. So incremental EPS means earnings, effect on earning divided by effect on number of shares. So potentially issuable shares, what can be different types of potentially issuable shares? It can be written call option, convertible loans, and then share-based payments. Normally these are ignored, but share-based payments are also part of dilutive earning per share because these are also the contracts in which the entity has entered, but these are yet to be issued. So share-based payments are also potentially issuable shares. And there is a trick as well in the calculation of dilutive earning per share for share-based payments as well. Here we use the word return, call oblique put. Call means right to buy. Put means right to sell. It should be written. Means the other party, the counterparty has a right. It not purchased call option, purchased put option. It cannot be because purchased call option and purchased put option can only be exercised by the entity if it's favorable. And when it is favorable, it's not dilutive. So only the written call options and written put options can be dilutive. And those can only be, in case of written call, the market value is more than the exercise price. And in case of put, the exercise price is more than the market value. So it's very important that these written call and put option can only be considered when they are dilutive in nature. Okay, as potentially issuable shares are not issued yet, but we are including them in the weighted average number of shares. So how we will determine that for what period they should be included in the weighted average number of shares? So the standard provides information if the contract for potentially issuable shares has been in existence for a full year, it will be included in the weighted average number of shares for the full year. If this contract has been issued during the year and it is outstanding at the end of the year, it will be included only for weighted average for that period for which this was in existence. And if a contract is in issuance at the start and exercised during the year, it will be only included in calculation of dilutive EPS for that period in which it was outstanding. If this contract was issued during the year and exercised during the year, then it will be only included in weighted average for that part of the year in which it was outstanding during the year. So it's very important that for dilutive EPS, they only become part of the weighted average when they were outstanding, they have yet to be exercised. Okay, these are the 5 steps which we apply in calculation of dilutive earning per share. I already explained. Okay, in case of written call option, important thing is there is no effect on earning. Rest of the things are same, but very important in case of written call options, we are also charging some price as well. So the dilution or the dilutive effect is only for those number of shares which are issued for nil consideration. So you basically calculate those options which are issued for full consideration and those which are issued for nil consideration. There's a very simple factor. Options under contract multiplied with exercise price divided by market value. That will be those number of shares which are issued for full consideration. The rest of the number of shares will be for nil consideration. So only the number of shares issued for nil consideration will become part of the dilutive earning per share. And then written put option. Basically, in this case, we assume that how many number of shares we have to issue to buy these number of shares. Actually, we have to issue shares at market value and buy shares at exercise price when the party will exercise a put option, when the exercise price is more than the market value. So we have to issue more shares at market value to buy less shares at exercise price. The difference between that number of shares is basically the shares which will be used for dilutive earning per share. And then in case of convertible loans or preference shares, they have effect on earning as well as on number of shares. So in case of share-based payments are also like written call options because you give the other party the right to buy your shares. But in case of share-based payment, the employee has to render services in the future as well. So the standard requires that what is your unamortized expense divided by remaining number of years of, let's say, vesting period. That amount is basically also part of the exercise price. Let's say you say this share is for rupees 20, market value is 50, and unamortized expense is 30. And there are 3 years on which the employee has to render the services. 30 divided by 3, 10 rupees is the exercise price which the employee has to make services before exercising this right. So that portion of, you can say, non-vested share-based payment will also become part of the exercise price. So it's very important. Share-based payment will also affect the you can say your basic, your dilutive earning per share. Okay, let's have an example. Just go through this example. It will be, I will provide these examples. You can go through, but here is an example. Okay, let's have. Okay, one thing left, I think, which I should explain in detail. When we assume that this is my potential issue. This also ignored many entities while calculating dilutive earning per share. When I assume, let's say this potential issue shares have been issued. Standard says not only the saving on this instrument, but it may have certain consequential effect on other expenses as well. Like we all know, if a convertible loan is converted during the year, you may have saved the interest, but in that case, your profit may have increased and your contribution towards WPPF and WWF may have increased. Normally, we ignore that. So please be careful. When we assume this potentially share have been issued, not only the saving on that potential issuable share net of tax will become part of my profit, but also its consequential effect on other expenses will also be incorporated. It's very important. Okay, this example, Imran Limited has the following results for the year ended 31st December X7, earning net profit 10 million, ordinary shares outstanding during the year 2 million, return call option की जो आपकी fair value during the year is 75, tax rate is 40%, then profit for the year is net of 20% profit attributable to employees profit sharing scheme, call options, return call options, exercise price is 60, convertible preference share 800,000, and 8 per share is a preference dividend. Then we have 5% convertible bond, nominal amount is 100 million, and then each bond is convertible into 20 ordinary shares. And there is no discontinuing operation, so whole of the earning is from continuing operations. And here is my basic earning per share 5, which is earnings divided by total number of shares. And then we are going to calculate dilutive earning per share. So first of all, first step is our control number. Control number is the number from where we want to calculate the dilution. And that is 5, which is your basic EPS from continuing operations. And then we have different types of potentially issuable shares. First of all, we have option. As I already discussed in the slides, there is no effect on earning, and there will be on effect on number of shares, but only those shares which are issued for nil consideration. And the formula is total options minus options multiplied with exercise price divided by market value. Multiply with your number of months. There's no information given for the number of months outstanding during the year. We can assume it's, let's say, 12 months. So here are the 20,000 number of shares which are going to be issued for nil consideration, and incremental EPS is 0 because nil divided by 20,000 is also nil. Now we have preference shares. 6.4 million is effect on earning because we are paying 8 per share dividend to the preference shareholders, and 1.6 million is the number of shares we are going to issue. So the incremental EPS is 4. And then for convertible loan, there is a 5% interest. 5% interest, but there is a 40% tax rate. So the only increase in saving will be 60% net of tax. But as our earning has increased, our contribution towards profit sharing schemes will also increase. So consequential effect of 600,000 will be deducted, and then 2.4 million will be our earnings, effect on earning, effect on number of shares will be 2 million, and incremental EPS will be 1.2. And then we have the ranking. 0 is number 1, convertible loan is number 2, and preference shares are number 3. And then we have cumulative EPS by adding option. We only added this 0 in our earning, this number of shares in our total number of shares, and the result is 4.95, and our control number was 5. It means our option is dilutive. And then we added convertible loan with this cumulative. The dilutive EPS is 3.08, and then after adding preference shares, it has started rising. It means preference shares are anti-dilutive. But if you compare this 3.35 with 5, which is control number, it seems dilutive, but standard required that you should calculate most dilutive, and that is 3.08. Okay, next we have a presentation. It must be presented on the face of the profit or loss, both basic and dilutive with equal prominence. And then in case of bonus issue, right issue, or split or consolidation, you have to give retrospective effect, or if there is any adjustment under IS 8, rectification of error, or you can say change in accounting policy, again you will go retrospective and change basic EPS and dilutive EPS. Okay, that's it. Thank you. Question? Okay, question is, if there is a real estate company that is developing real estate or certain, you can say, buildings, whether the borrowing cost can be part of the cost of the asset, the answer is yes. Because if it's an inventory under IS2, or you can say it's you can say property, plant and equipment under IS16, or it's a investment property under IS40, and under IS40 you are using cost model. In all three areas, or in all three, you can say, types of buildings, you can add borrowing cost, but important thing is it should be a qualifying asset, and it takes material time to get ready for its intended use or sale. जी 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 ठीक है जी नहीं जी money under what arrangement? As a right issue. As a right issue. Unless the shares have not been issued. Unless the shares have not been issued, they don't have any effect on, you can say, the basic earning per share. As far as the dilutive earning per share is concerned, basically whether the company has the discretion or the shareholder has the discretion, because it doesn't satisfy the definition of a written call or written put option. And in case of right issue, you have to issue shares within 45 days or 30 days. Shared about money is? That's why what under what arrangement you have got the share deposit money? No. If share deposit money in the form of right issue, the only issue is whether the only issue will be at the year end. At the year end, it was a share deposit money, and after the year end, the shares have been issued. This is the case, or normally we get money from the shareholders and there's no contract to issue shares, and that you can say lies within the equity. That is basically the concept of share deposit money. What type? If the shares have been issued subsequently, then IS 33 basically requires from what date the shares can be included in the weighted average number of shares. From what date the shares can be included in the weighted average number of shares. In that paragraph, there is a chance that you can include that in share deposit money in the calculation of basic earning per share, not in dilutive earning per share, in basic earning per share. But I have seen two types of approaches. One is they are not considering it. But if you read that paragraph, there is a chance that you can include that in the weighted average number of shares from the day you receive the share deposit money. So that will be part of the basic earning per share, not dilutive earning per share. Potentially issuable shares means the contract which entered into by the entity and they are dilutive if, अगली बात है, if it's a written call or put option, exercise price and market value comparison, only the issued for nil consideration. Here is not a case of nil consideration. Convertible loan, the other party has a right. It's not a question of dilutive earning per share. It's a question of basic earning per share because it's being used for earning. It has been deposited. My opinion is it can be included in the weighted average number of shares when you receive the money. Yes, right issue proper hua. Otherwise no. No. None. The day right is splitted from the share is called as X right. The day right start trading in the market separate from the share. Otherwise, that is in the share. Come right. Preference shares convertible into equity. No. जिस डेट में आप शेयर की करेंगे तो फैक्टर और फैक्टर नहीं.
Dear participants, before going towards closing of this workshop, I would like to invite Mr. Asad Feroz for valuable insights. Mr. Asad Feroz is a fellow member of Institute of Chartered Accountancy of Pakistan. He is fellow member of ACCA, fellow member of PIPFA and Institute of Taxation and Management. He also remained short-term consultant with the World Bank. He is in practice and also a founding partner of Junaidi Shoaib Asad Chartered Accountants and
Thank you,
independent member of Morrison Global. Yes, sir.
Thank you very much. Assalamu alaikum, everyone. I hope you can hear me loud and clear. Zishan, am I audible? Honorable Chairperson NRC, Amara, Honorable former Chairman NRC and our friend Mr. Farooq Hamid, Yasir Yasab, our presenter for today, honorable members joining us in person and through Zoom. Indeed, it is a very momentous occasion that we have arranged at ICAP level, a refresher on IFRS and IAS. I think it was much needed, and we need to continue doing it at least on a 6 monthly basis. because as globally things are changing, the demand for IFRS, the implementation of IFRS and IAS is also increasing. And not only it is important for our members in industry and in practice to refresh their knowledge after a certain period, as so many changes are happening now and then, it is also a very good service avenue for all members actually. So many assignments come in where the expertise of IFRS and IAS are required. What Northern Regional Committee has done brilliantly over the 4-day refresher course is that they have tried to cover almost 16 IAS and IFRS, which is very heartening. And I think, again, the knowledge that has been shared by the 4 presenters that we had, Mr. Bilal, Mr. Hamad, and Yasir Yasab today. And I think all of this knowledge is very, very important. And at ICAP level, we continue to give you opportunities. The regional committees, the Northern Regional Committee is playing its part by imparting knowledge to you. They are also arranging the conference for students, which even members can attend, which is titled on artificial intelligence. Again, technology is very close to heart if you ask me from the council perspective is concerned. The strategy that we made 2 years ago, and then we tried to refresh it in the current year as well, the whole profession is turning towards technology, and it is going to be a mash of technology and accounting in the future. We really need to be mindful that we are actually skilled as far as knowledge of our core areas like IFRS, ISAs, IAS are concerned, our knowledge of the local corporate laws are concerned, but also the other elements that are related like blockchain, AI, and the data, the courses that we are doing on digital side are very, very important. I think one course that we have developed regarding the digital auditor is very important. That is also being started now and being done by the Digital Accounting and Assurance Board of ICAP. That is very nice. The data analytics program already in its 7 cohorts have been done. It has been very widely received. Then we are also planning different activities from different committees, and it is, I think, a lot of knowledge that is there. We have developed the LMS, and LMS has different courses being placed there, and you can watch it and you can view it at the time of your convenience. And the chairperson told me just a few moments ago that this session and the 3 sessions before this will also be uploaded on the LMS, and the presentations will also be sent to all the participants and would also be available online. I think knowledge is something that is very important, and we need to share it with everyone. And ICAP is trying to play its part. Wherever you see there are any pitfalls or shortfalls, do let us know. You are mostly connected with us, or either through WhatsApp or email or any other physical interaction that you have. I'm very sorry I could not make it today. I had to rush to airport in a few minutes. So if I had to come to ICAP and then go back, that would have been difficult. My flight schedules changed. Otherwise, I would have been love to come here and meet you in person, all of you, after a long time. But apart from everything, we are also thinking of doing out-of-box activities soon. We are thinking of taking you to a new journey in finance, how you will be building robots. And this is going to be, I think, a good event. We are planning it somewhere in 2 to 3 weeks. And again, the regional committee is doing different activities. I understand there is a session for new chartered accountants, the new members that are coming in. They are also in the pipeline. Then we have many other activities lined up. We have a conference in Dubai on November 28th. Again, it is targeting technology and sustainability. It will be held in Le Méridien Hotel, Dubai. For those of you who are overseas, we would love to see you there. And the chair, President IFAC, Madam Asma, has kindly consented to be the chief guest and a keynote speaker there. We have so many local speakers from UAE there, and we have some other speakers from IFAC also coming there. So there is a lot of activity going on at this time in ICAP, and we are thankful for your participation and your continued patronage. Looking forward to your feedback. I would like to again appreciate the Northern Regional Committee, the chairperson, Madam Amara, Farooq Hamid Saab, who I understand is chairing the CPD committee, Anil Peter, who organized the events in Islamabad, and rest of the team of NRC as well. They deserve a lot of appreciation for doing all these efforts. Thank you very much. Have a great evening. You must be very tired. So let me say goodbye to you. Allah Hafiz. Thank you very much.
Dear participant, as we come to the end of this remarkable refresher workshop on IFRS, I would like to invite Ms. Amara Shamim and Mr. Farooq Hamid to present a shield to Mr. Yasir Riaz, who delivered the valuable insights and knowledge regarding IFRS. Sir, please. Thank you very much. Please feel free to reach out to our team with any question, feedback, or suggestion for future events. Thank you very much.